market is currently making a major potential reassessment of valuations of U.S. assets.
It's not a necessary sell everything type of an environment.
I have a difficult time seeing where the genuine new positive catalysts are going to come from.
A lot is going to change day to day and week to week.
Uncertainty is high, not just for the economy, but for investors.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, and the White House is pushing for China to come to the table.
The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country, except they are much larger. And China wants what we have, the American consumer. Or to put it another way, they need our money.
This morning, the conditions. According to people familiar with Beijing's thinking, China wants to see much more respect before agreeing to talks. This after tensions ramped up overnight as President Trump barred Nvidia from selling its H20 chip in the country. Weighing on chip stocks this morning, ASML, reporting orders that missed estimates, and the company warning it doesn't know how to quantify the impact from recent tariff announcements.
To me, that was one of the most interesting aspects, because how do you quantify a potential 145% tariff rate on China? There already have been restrictions. As we see with Nvidia, you pair these two stories, those restrictions can change. They made this chip specifically for China. Suddenly it is now exempt, and they cannot profit from some $5 billion that they were expecting in revenues. Key question here, what is the ultimate goal? Is this national security? Is this trying to sort of get some sort of trade deal? Or is this something else that we haven't put our finger on?
How do you guide with limited visibility? Do you do it a United Airlines? I have to say, the C-suite's starting to sound like a Wall Street strategist. Here's my base case, here's my bear case. That's what we heard from United yesterday.
And they kind of have to, right? They talk about one case where potentially their profits could be $13.50 a share, or it could be $7 a share, depending on whether you get a recession. Mohamed Al-Arian came out and he said this, and it was on an X post. I thought this was fascinating. This is why it's important to think in terms of multiple scenarios for internal planning and not just stick to the usual. Is United the path ahead?
United and Scott Kirby coming up a little bit later on this morning, so look out for that conversation. We've got to unpack the China issue as well. The issues and the approach. China wants a point person. Based on our reporting here at Bloomberg, Wall Street wants the same. And I think we heard that from Jamie Dimon in the FT just yesterday.
Yeah, Jamie Dimon said that he knows Scott Bessent a little bit. He thinks he's the adult in the room, and he thinks he should be the person leading those negotiations. When I spoke to Scott Bessent earlier this week, what he did say when it comes to the trade negotiations that are starting to develop right now, not with China, but other trading partners, he says there is now a process in place. Potentially they can get the 70-plus countries done first and then confront China, but at this point, they will have a process that is in place.
Our report just showing a small glimmer of hope that maybe China will come to the table. You see the equity move? Bang, up, just like that. This is what the market is looking for, is what it's hoping for.
What you saw in futures was really just, it had been creeping lower to almost 0.5% down. All of a sudden, boom, almost flat. And this is essentially the off-ramp that people are looking for at a time when potentially that is the only hope to avoid a scenario that, as many companies are saying, they cannot even start to quantify.
China has finally responded. We've heard time and time again from the President of the United States saying basically, we're going to be gracious. I'm waiting for Xi to call. But can they meet this bar? They want to appoint a person, willingness to address China's concerns on sanctions in Taiwan, a more consistent U.S. position, and then respect and reining in disparaging remarks when it comes to China. That may be difficult for some members of Trump's cabinet.
Equities recovering this morning, still lower. We're down by 0.7%. Coming up this hour, Jack Caffrey of JPMorgan Asset Management. As stocks snap a two-day winning streak, we'll catch up with Dan Clifton of Strategas as the White House puts the ball in China's court, and Erika Najarian of UBS as big bank earnings wrap up on Wall Street. We begin this hour with stocks recovering on signs China is willing to talk. Jack Caffrey of JPMorgan Asset Management writing, even with a pair of rallies last week that managed to produce a year of normalized returns within a trading day, there is no major sector that is looking overbought. Jack joins us now for more. Jack, good morning. Good to see you.
Good morning.
Let's get to it then. Is this the calm after the storm or the calm before the storm?
Might be the eye of the hurricane, actually.
Is that what it feels like?
You can talk to me again in 2 hours, to be honest. And I can give you the base case and the bear case, realistically. But realistically, I think what we started seeing 2 weeks ago, 3 weeks ago, was a framing of what might absolute really bad look like and what might a path towards normalcy look like. And I think markets are trying to grasp around this idea of what might we hear consistently And that actually gives you room for which to actually think about, with a consistent strategy, with the tactics to get you to that. Then we can actually start framing what is the right multiple to pay for an earnings story, with understanding that the earnings story is going to be kind of messy in its own right. We're early enough into earnings season that we should stop calling it earnings season, because for the most part we knew the economy was okay, and it really hangs on guidance. And I think companies are even more grasping for what they might think about that operating environment looks like.
So that guidance, really helpful right now. Basically, we have no idea how to quantify this, or you can drive a truck through the estimates of the range of outcomes as we saw at United. What are we pricing in right now? And how do we get some sort of clarity on whether it's tariff uncertainty or whether it's potentially some sort of economic downturn?
Certainly economic surprises have been materially weak over the last 6 to 8 weeks. So that certainly suggests that there should be some some slowing in the aggregate. We've taken our earnings estimates down from a low double-digit rate of pace. Last time I was here a month ago, you tried pinning me down on the number. It now looks something closer to 5 or 6% in terms of still earnings growth going forward. Companies are very good at managing A, expectations, and B, they'll probably manage their costs well. Unfortunately, the more they manage their costs, the more likely we're going to see unemployment creep higher. You're going to see some postponing of capital spending, and that will raise some questions about what that growth outlook in the aggregate starts to look like. But again, tell me what the rules are, and then companies will figure out what they should be doing. Talking about, the H2O chip, that was engineered for that was a chip engineered to comply with trade restrictions in place by the prior administration, new terms of trade, and now we wind up having to re-engineer the business. Based
on the fact that we don't know what policy is and we're not sure exactly what the parameters or goals are, does big tech become uninvestable?
I don't think it's uninvestable, but it certainly has proved to be less of an automatic ownership position than it's been over probably the last 14 years. And I do think that speaks to, you can find interesting U.S. businesses that should be able to grow here. We're talking about the ongoing debate between the Magnificent Seven and the not quite forgotten 493. But the not quite forgotten 493 are a little bit more domestically oriented. They are probably less subject to some retribution when one thinks about, how do I start putting some pressure on trying to get corporate executives to try to lobby for a more consistent communication path, a more consistent policy path on a look-forward basis. And they're generally a little bit more domestic. When you start thinking about, where your patents, where your intellectual property is headquartered, and where that might be subject to pressure.
The Treasury Secretary says that the financial community should take a constructive view and look at the 3 legs of the Trump policy stool when it comes to tax cuts, deregulation, and tariffs. If you take their entire policy proposal together, do you have a more bullish view on potentially where the market's going?
I thought the 3 stools were 3% real GDP growth, 3% inflation, and 3 million incremental barrels of oil a day. So a nice reminder, perhaps, that we keep changing the terms under which we be judged. I wish when I was a student I could readjust what I was being tested on after I wrote the essay, but, I lived in a different world.
That was just one policy proposal that the Treasury Secretary was offering up. But Trump ran on 3 proposals, which is tariffs, tax cuts, and deregulation.
Yep.
So when you start seeing maybe the end of the year, tax cuts and at minimum extension of TCJA, does that give you some comfort when you see back and forth whirlwind of trade headlines?
I think there is a narrative that is quietly spoken in the market that the first month and a half have been designed to satisfy the base, and that the second half will be designed to satisfy the donor. That would be an interesting pivot in terms of what winds up coming through. That would look like deregulation. That would look like structural tax reform, but some parts of tax reform are sounding like tax increases, depending on where you wind up sitting in terms of what we wind up going through. Taking away things like the deductibility of local interest expense for companies at the same time you're telling companies to build large plants. So you wind up having some interesting puts and takes that can make for some interesting and, dare I say, confusing headlines. And I think, right now it's probably good to be a lobbyist in terms of being able to run up your billable hours and still be deductible.
It's certainly difficult to be an investor, let's put it that way. The sequencing is different to what we expected, Lisa. It's different to what we saw in the first term of the Trump presidency. And it's not just that. They've started with trade, but the methodology and execution has confused a lot of people as well.
Especially if the end goal is to essentially bring the trade deficit to zero. What would that do in terms of undermining the dollar position in a global currency type of perspective? And that's something that we see on an ongoing basis and raises a question. Is a weaker dollar going to be a tailwind for companies that are exporting abroad? Or is it not really going to matter? Because ultimately, the terms of trade are changing and the appetite is also changing.
Jack Caffrey, it's good to see you, sir. Thanks for dropping by. Appreciate your time. Jack Caffrey there at JPMorgan Asset Management. The euro at the moment against the dollar, euro-dollar about 113.61, so more dollar weakness this morning and euro strength, to Lisa's point. The equity market recovering a touch. We were down by more than 1% a little bit earlier this morning. Lisa, we're now down by just 0.6%.
Yeah, people assessing just how much there is an off-ramp. I love the idea, as you guys were discussing, that China is saying, look, we would be flattered if President Trump would want to negotiate directly with us, but maybe it would be better if delegates from both sides could come together and in a calm voice figure out what it is that we want to do going forward. I just, that's the messaging coming out of China.
China wants to deal with one voice.
They do.
Jamie Dimon at JPMorgan basically said to the FT that he'd like to see one voice, and he named that voice. The Treasury Secretary, Scott Bessent.
Of course, and China has always wanted to deal with Treasury. They always felt like that was a way into dealing with any U.S. administration. The problem is you have a cast of rivals, as Terry Haynes of Pangea calls it, when it comes to the Trump administration. Scott Bessent, maybe the more constructive on trade, but the likes of Howard Lutnick and Peter Navarro are certainly want to have their voices heard when it comes to a place like China.
They've gone a bit quiet over the past few days, that's for sure. Equity futures on the S&P negative by 0.7%, with an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. China says that it's open to trade talks with the U.S., as you were discussing, but only after President Trump meets its requirements, like reining in remarks from his cabinet members. Sources tell us that other conditions include a more consistent U.S. position and a willingness to address China's concerns around sanctions and Taiwan. The White House is banning NVIDIA from selling its H20 chip in China, a clear sign that the administration will stay the course on limiting China's AI ambitions. The restrictions will require a license to export the chips for the indefinite future. NVIDIA warns it will likely report a $5.5 billion write-down tied to inventory and commitments. And a check on United shares this morning. They are higher by 6.4% in the pre-market. Took the unusual step of offering not one, but two possible earnings scenarios, saying its 2025 outlook remains achievable, but also warning that a recession could nearly halve its profit forecast. The split forecast in reaction to the uncertain macroeconomic backdrop. And that's your brief, John.
Danny, thank you. Appreciate it. More from Danny a little bit later, and more from United Airlines later as well. We'll catch up with Scott Kirby, the CEO, later on this morning in a few hours' time. Up next on the program, pushing for China to come to the table.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. They need our money.
Up next on the program, some reporting on China's reaction. Dan Clifton of Strategas, a bad company, joins us next. Live from New York this morning. Good morning. Struggled to grind out a third day of gains in yesterday's session. We snapped that two-day winning streak on the S&P 500, and we continue to decline this morning. We're down by 0.75% on the S&P. Under surveillance this morning, pushing for China to come to the table.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country, except they are much larger. And China wants what we have, what every country wants what we have, the American consumer. Or to put it another way, they need our money.
So here's the latest this morning. The team here at Bloomberg reporting that China is open to trade talks if the U.S. administration shows more respect and is willing to address its concerns on Taiwan. Bloomberg's Tyler Cantor joins us now for more. The ball is in China's court. Tyler, what is China telling us?
Yeah, hey, John, good morning. Well, this is really the first insight that we are getting into what could potentially bring down the temperature after weeks of escalation. A source familiar with the Chinese government's thinking tells Bloomberg News that the most important precondition for talks is that Chinese officials feel that they will be treated with respect during them. It appears that Beijing would like to start to see President Trump disavow comments from his cabinet members when they are critical of China, even as President Trump himself says that he has a good personal relationship with Chinese President Xi Jinping. Also, importantly, we're learning that Beijing appears to want the U.S. to appoint a point person to lead these talks that can speak and act in President Trump's capacity, even as President Trump himself still contends that he is waiting for Xi to call him directly. And we should probably note that direct calls to the White House have actually helped to expedite negotiations in some cases, such as after President Trump himself had talks with his counterparts in Japan, South Korea, and Vietnam. And Xi is also currently on a tour of Southeast Asia, where he's engaging directly with leaders in a bid to shore up support with them. Now, Bloomberg Economics estimates that once these talks do restart in earnest, they will likely take months and probably take us into 2026 because, John, it is an understatement to say that there is a lot to tackle here. But with tariff levels at record highs, we're now really starting to see the escalation point to those non-tariff barriers, such as a tightening of export controls. As you mentioned earlier on the program, of course, NVIDIA announcing that the U.S. has tightened restrictions on the exports of one of its more toned-down chips, scaled-back chips to China. And China really appears to be trying to restrict market access for U.S. firms, such as yesterday announcing the suspension of those Boeing deliveries.
Tyler, when it comes to this report, according to the person familiar with Beijing's thinking, the most important precondition is that Chinese officials need to know such engagements will be conducted with respect. They want the president to rein in some cabinet members that have disparaging remarks about Beijing. Who do you think China's thinking of?
Well, as our report indicates, China issued a rare rebuke after some recent comments from Vice President J.D. Vance when he was talking about how the U.S. is engaging when it comes to manufacturing in China. And that does appear to have sort of set off alarm bells when it does come to Beijing. We have to keep in mind here that this administration, so far, most officials really have been trying to engage with China. When we do see President Trump saying that he does have this strong relationship with Xi Jinping and that he wants him to call them. But important to note that we do know that negotiations had actually started months ago, particularly back in February when China was first slapped with that 20% tariff across the board. But it appears that they couldn't get over that initial negotiation when it came to fentanyl concerns. And since then, the gap between the two countries has only widened.
Tyler, appreciate the update. Tyler Cantor there down in Washington, D.C. To extend the conversation, Dan Clifton of Strategas, a bad company. Dan, welcome back to the programme. The U.S. and China came to an agreement in the president's first term. How much harder will it be to come to an agreement in the president's second term?
Well, that took 20 months to get to that agreement, and that agreement was reached in January of 2020. We obviously had COVID after that, but the Chinese did not follow through on their commitments that they made to the United States, and I think that's still a sticking point here. So when I look at what's happening with U.S.-China talks, I think it's important for investors to see directionally if there's some sort of negotiation opening up. But I don't think that that's going to be the first one. In fact, I think that might wind up being the last one. And much of the negotiations I think the Treasury Secretary and the U.S. Trade Representative want to do is start to line up U.S. allies and start to ask those U.S. allies to be tougher on China, whether that's going to be in Japan or Vietnam or many of these other Asian countries. And I'm just much more looking forward to progress with U.S. allies on some of these trade issues and looking for progress on the tax bill before we see any meaningful progress on the China trade agreements.
When it comes to a Chinese trade agreement, though, what's on the table this time around that wasn't there in Trump's first administration? We've heard the president talk about things like TikTok. What else can possibly go into this negotiation?
Yeah, well, TikTok is one of them. I think there's going to be some non-trade issues around these discussions that would even extend beyond that. But when you look at it in terms of what the U.S. is looking for China, they're really trying to clamp down on those non-trade barriers. The stealing of intellectual property is still a major issue that's out there. They're probably looking for some direct purchases. I think that's going to be true for most countries, whether that's agriculture or liquefied natural gas. These are going to be big issues, auto access. So, you know, when you pull it all together, it's going to be a combination of tariffs, non-tariffs, and purchasing of U.S. goods. And then you can throw in all that fun stuff like TikTok and see if you can get some sort of deal there. I do believe that the president has geopolitical issues that he would like to wrap in with China as well. That is clamping down on Putin and seeing if there could be resolution on the Ukraine war, areas such as Iran and North Korea. So I think everything's on the table once you get into these trade talks. It's not just about trade policy.
Dan, you mentioned Japan. The president is awake and already posting on social media. This is what he has to say. Japan is coming in today to negotiate tariffs, the cost of military support and trade fairness. I will attend the meeting along with Treasury and Commerce secretaries. Hopefully something can be worked out, which is good, great for Japan and the United States. Dan, who's at the front of the line when it comes to negotiations?
Well, I think Japan and Vietnam are at the front of that line. You can also say that South Korea and maybe even India, to a lesser extent, are probably in that line. But look at what Japan is doing. They're talking about reviewing the U.S. Trade Representative's report. They're looking at all the non-trade barriers. Can we change the safety rules on autos to allow more U.S. cars to come in? Extremely constructive, very different than what you're seeing from Europe, which is like, hey, we'll buy your liquefied natural gas, which is probably not going to be enough. And that's why there's less optimism about some sort of deal with Europe on trade, particularly in the short run. So I think that the Japan talks are in good faith negotiations. What the president is saying there is really important. The president's saying that he may not provide military support for countries that the U.S. historically has done if they're not willing to negotiate on trade. He's using all the leverage points that he has to build a coalition, to build a better trade system in his mind, and stopping at really nothing, things that were not talked about in previous administrations before.
What can partners like Japan do to also make sure that they are isolating China, something that this administration seems to also want to be an end goal and part of the discussions when it comes to trade deals?
Yeah, awesome question. So, when you look at it, Japan had a 24% rate in the president's April 2nd report. You got a 10% tariff on them. You need about 14% to gap the difference for the trade deficit if you're going to go off that math. So obviously the first things that are going to be on there is more involvement in the U.S. That requires about $20 billion of spending from Japan, or about 0.5% of their GDP on U.S. goods. That's a hard deal to reach alone. And then it gets to the heart of your question, what are you going to do for Japan? And what the U.S. is concerned about, particularly in the Asian countries, is that these goods are coming from China through Japan and then into the United States. So they want to limit that. What the Treasury Secretary has been talking about, and this is why China's got to be careful looking at, for him to be the point person, is that he's been talking about these countries putting tariffs on China just like the U.S. is. He had those conversations with Mexico, and I believe that he'll probably have those conversations with the Asian countries as well, and really start to isolate out China and start to build sort of this kind of coalition of allies that creates a more kind of modern trading system that leaves China out if they're going to continue to break the rules.
Dan, how realistic is this? This has been the nightmare for the Vietnams, the Malaysias, the Philippines, as well as Latin American countries, that they would have to choose between the U.S. and China. We saw Xi Jinping head over to Malaysia in the past few days. Is it feasible, especially for those so close geographically to China, to be forced to choose between the two major economies of this world?
Yeah, it's very tough. I mean, when you look at Vietnam, it's about 14% of their GDP, the U.S. tariffs, like in 1 year. That's like an amazing amount of austerity that's being placed on them. And so some of these countries take it very personal, like you don't want us to have any type of economic growth. And you got to work through those issues overall. So in a way, I don't think that many of the exact goals that were put out by the administration are going to be reached. But I think if they move there directionally, you'll start to see it. If what choice do they have? If they don't make an agreement with the United States, those factories are going to close in Vietnam and they're going to go to Mexico. And I think it's very interesting that Mexico was left out of the universal tariff and all the April 2nd items after initially taking the brunt of Trump's sledgehammer at the start of this administration. Feels like Trump is trying to bring those supply chains closer to the United States for national security purposes, and that's why they don't really have an option. They're going to have to figure that out if they want access to the U.S. consumer, and if not, then you'll see a break. But I just don't think that there's enough Chinese demand for those countries to be able to replace the lost U.S. demand.
Hey, Dan, appreciate the update. Dan Clifton there of Strategas, a bed company. Thank you, sir. The latest update then from the president, Lisa. Japan is coming to the table today to negotiate tariffs, the cost of military support, and what the president called trade fairness.
Yeah, and we knew that Treasury Secretary Scott Bessent was going to be meeting with them. First mover advantage. What kind of advantage do they get at a time where there are a lot of potential contentious issues on the table?
We'll come back to this story in just a moment. Up next, we'll catch up with Erika Najarian of UBS on a big quarter for the big banks from New York City. You're watching Bloomberg TV. Chipmakers went on stocks this morning. Equities recovering. We're still lower by 0.75% on the S&P. We were down by 1.6%, recovering on the prospect of China coming to the table for talks with the United States. We'll get to that story in just a moment. With 3 hours until the opening bell, let's get to your morning movers with Danny Berger. Hey, Danny.
Hey, John. I just wanted to give you a look at what some of those individual chip makers are behaving like this morning. NVIDIA down 5.7%, again in the eye of the storm. Its H20 chip, specifically developed for China, being targeted now with export restrictions and a needed license. NVIDIA saying that could cost them a $5.5 billion charge. It's not just NVIDIA, though. To your point, John, it is chip makers across the board. AMD really getting hit this morning, too, in the pre-market session. Down even more, 6.5%. The problem for them might not just be the export restrictions. It could also be the fact we had some pretty ugly earnings coming out of ASML in the Netherlands. They missed on their sales by about €1 billion. So you're seeing the entirety of the chip sector really hurting, considering they are also a crucial part of this supply chain. Finally, just wrapping things out with United trading to the upside this morning. Earnings yesterday, two very different forecasts. Perhaps this is the new playbook with uncertainty, saying here's our worst case scenario. Their worst case scenario, by the way, was about $7 per share. Their normal case scenario was on the high end, 13.5. So about halving if you do get a recession. Those shares up 6.5%, John.
More from Scott Kirby a little bit later, if we can get our microphones up. There we go. All right. Scott Kirby coming up a little bit later at 8:15 Eastern Time. On our radar this morning, China's saying it's open to trade talks if the US meets certain conditions. Sources telling us here at Bloomberg, China wants to see the Trump administration show more respect and a willingness to address concerns around Taiwan.
This is the first time we've really heard China respond in this great Bloomberg scoop, after you've heard from the White House yesterday saying the ball's in China's court. Some of the things they want is respect, reining in some of the rhetoric from cabinet ministers, a more consistent U.S. position. And then most importantly, Jonathan, and something you really touched upon, what Beijing is looking for is actually what Wall Street is looking for. Jamie Dimon yesterday was talking about the fact that there needs to be a point person, and Wall Street seems to be looking at the Treasury Secretary, Scott Bessent, to maybe take that lead driving seat.
In the meantime, both sides are clearly trying to create a sense of leverage heading into these negotiations. President Trump saying they want our money, the U.S. consumer and access therein is the most important thing. China saying, you want your rare earth minerals? Well, guess who has them? Your rare earth metals. And so this is really an interesting tit for tat as they both try to get position ahead of these negotiations.
Everybody's trying to position for leverage. Can the United States get their allies to put up trade barriers on China, which is where they have been consistent on this issue now for a number of months? Can they actually achieve that?
It is hard to see how a country like Vietnam, Malaysia, or the Philippines can make an enemy of China at a time when they have disproportionately benefited from some of the tariffs and the bans on what we've seen with the U.S. putting on China. They've been the connector countries, and suddenly they'll have to abandon those industries.
I asked the secretary about this, Scott Bessent, earlier in the week, and he said what China is doing is like that Fantasia Disney movie with the brooms and the buckets. Even if the U.S. tariff wall goes up, they're still going to be manufacturing, and they need to find a place to dump. So just by nature of what is going on, these countries are going to want to get on board so that they can also start blocking out some of the Chinese dumping that is going to happen.
Danny mentioned the chip makers, some of the movers in the pre-market going into the opening bell. Let's talk about them. Chip makers very much under pressure this morning. The White House slapping trade restrictions on NVIDIA, barring the company from selling its H20 chip in China. This coming as ASML reported lower than expected orders in the first quarter, citing tariff uncertainty.
It's difficult for these companies to know how to plan for the future when the future keeps changing. The H20 chip was designed for China with compliance from the previous constraints that the Trump administration had put on. ASML said it doesn't even know how to quantify the impact from the new tariff regime. This becomes very difficult for these companies to plan out, and frankly, it becomes very costly for them to try to adjust in real time. Again, macroeconomic paralysis.
United Airlines, a fantastic example of that. Love that, Jim Zelter.
Yes.
Fantastic phrase. United Airlines coming out with this, not one but two possible earnings scenarios. The company saying its 2025 outlook remains achievable, but also warning that a recession could nearly half its profit forecast. You've now got the C-suite, Lisa, offering a base case and a bear case. That's how difficult things are. They're flying with very, very limited visibility.
What's interesting is, first of all, they have no better visibility than we do. And flying, I like the pun. That was very well done, by the way. Yeah, thank you. The other thing that I want to note is that United actually had a pretty strong outlook, just more generally. Consumers are still strong. How do you pair the reality on the ground, which is a lot of strength, with a lot of the negative prognostications at a time where there really is just a cloudy forest that we're walking into? And that is the difficulty right now for these companies. And right now, that is the difficulty that a lot of investors have.
Two things I took away from that. One, their bear case is actually not so terrible. And also, as you saw Mohamed Al-Arian on Twitter coming out, talking about this illustrates the uncertainty felt by quite a number of companies. That at some point you need to think about, well, we can either be in this fantastic area or there's a recession and we're going to have to deal with that. And they're actually starting to put more people at work, like you said, Jonathan, becoming Wall Street analysts. They are just craving, they are so thirsty from certainty in Washington, D.C., and I hate to say this to them, you're not going to get it anytime soon.
We're not going to get it now, that's for sure. Equity futures on the S&P negative here by 0.8%. On Wall Street, projecting confidence. Bank of America, JPMorgan, Citi, seeing a boost in consumer spending. Citi CEO Jane Fraser saying this, looking past the current uncertainty and saying, when all is said and done, and long-standing trade imbalances and other structural shifts are behind us, the US will still be the world's leading economy. Joining us now to discuss, Erika Najarian of UBS. Erika, welcome back to the programme. As we wrap up earnings season for the big banks on Wall Street, we've been talking about this over the last several days. They've projected confidence, raising the guidance at JPMorgan, coming out with a buyback of up to $40 billion at Goldman Sachs. What underpins, Erika, that confidence?
Look, I mean, at the end of the day, they're making a lot of money. Capital markets may be at a pause, to paraphrase Lisa. It's hard to plan for the future when you don't know what the future holds. But, trading, like I said last week, was lights out. Growth wasn't bad, even on the commercial side. And, actually, I would say that card growth actually slowed a little bit, but it wasn't as dire as everybody had feared coming in. So at the end of the day, if you're thinking about all that volume and a decent level of interest rates to multiply that by, it's not a bad showing. And speaking of, the ability to buy back stock, the stocks essentially started pricing in a recession back in March. And with all this capital that's been produced, by strong earnings, the banks are saying, look, we're willing to buy back our stock cheaply.
One thing that we heard from the Bank of America chief financial officer as he came out, he said, we've got a healthy pipeline and our clients are simply waiting on more clarity on trade policy and the regulatory environment before committing to deals. Also, employment proving to be resilient. And to your point, Erika, the consumer hanging in there, maybe pulling back a little on cards, but still paying their bills. Erika, are banks still a leading indicator for economic prosperity or economic trajectory ahead? Or are they kind of something in their own bubble based on their selectivity in terms of their customers as well as their fortress balance sheets?
Yeah, that's a great question. So I would say they're a little bit of both. They're a leading indicator, I think, because of the activity levels. So I think it's, what's interesting to point out, Lisa, the pipeline is actually even stronger than it was last quarter. So when you hear Bank of America or Goldman or JP, the pipeline for new deals is actually stronger than even ending the fourth quarter when we were so hopped up on animal spirits. And so if we actually understand the rules of tariff land, we actually could have even better activity levels. And if the stock market starts reflecting that, that could actually perhaps reboost consumer confidence. Who knows? But to your point, I really like that point you brought up because of sort of the decade-long transformation that was really driven by, a generational change in regulation and zero interest rates. You really took a lot of risk out of the banking system. And while, card risk is pretty much the same at this time as it was, let's say, 10, 15, 20 years ago, a lot of corporate credit risk is now, really diffused outside of the banking system. So banks may not be necessarily a leading indicator of commercial real estate or commercial pain any longer.
Heading into this earnings season, one of the big questions was just credit quality, whether there still would be the activity that people had expected. I'm wondering if we're asking the right question, if it's really looking for weakness or whether it's recognizing the ongoing strength, despite some of the uncertainty, at least at the headline level.
So, it's hard to know what question to ask, right? Because, on one hand, you're looking at, pretty decent activity levels still, that's driving pretty good revenue growth. And then you're looking at the inventory of future credit problems and they're just not there. But then you're looking at a market that's really concerned about what tariff policy is going to do to the U.S. economy. And all the banks can really do is play defense, right? Defense with their capital. And what you saw this quarter is banks really build their rainy day credit reserve and say, hey, we don't know what's going to happen. The inventory of future losses really isn't quite there yet, but we know you're worried. So we're going to move capital from one part of the balance sheet to another in our loan loss reserve and save for a rainy day.
Erika, who's best positioned when it comes to the banks, when it comes to policy uncertainty?
I hate to give you the boring answer, but really, JPMorgan. I think at the end of the day, they just have best-in-class capital. They have a diverse set of businesses that they're, particularly, top in, and they're not particularly reliant on, international, or revenues. And so, again, I hate to be boring, but I really like how JPMorgan is positioned here. I think probably I would say an underrated answer would be Bank of America. Bank of America has a lot of strength underneath the surface. They tend to be very domestically focused. And by the way, the knock on that stock is that they haven't taken as much risk as Jamie Dimon has. And if you're really worried about the trajectory of the U.S. economy, that stock hasn't acted as defensively as it should. And so I think the underrated, best positioned bank out there is actually B of A.
Erika, before you go, can we just finish on JPMorgan and Jamie Dimon and that interview with the Financial Times? I don't think it's been talked about enough. That's the first time that I've seen Jamie Dimon really entertain life after JPMorgan. He says at the end of the interview, in the quote in the print edition of the story, that he could be a competitor or an aide to the FT. It's something I think all the papers should be doing, but I'm not going to tell you what it is right now. Erika, how close are we to Jamie Dimon stepping aside?
So he did tell us he still has a couple of years yet. And so, personally, I'm watching every time I, commute in from the Upper East Side. I watch how far the building, how much progress we have in terms of the new building over at 270 Park to see. I think he's going to cut the ribbon, but he does have a world-class bench. So I'm not sure, investors are all that worried. But I think we have a couple of years left. But I think that's a good observation because it's clearly, the biggest and most watched succession story in financial services.
We're certainly getting closer. Erika, appreciate your time as always. Erika Najarian of UBS. I think we're all doing the same thing. It's been busy in that part of Park Avenue for a number of years now. This line here, there's a little media thing I may do when I'm done with this job.
There is a sense that he's been planning for it. He said vocally that succession planning is the most important job for him right now, which is the reason why there has been this rearrangement and sort of a beauty contest at some of the top officials at JPMorgan. Teasing a little bit more, is he going to run a new publication, The Diamond Daily?
I've got no idea. There's a great name for it, though. We'll see.
Okay.
Equity futures on the S&P. We're negative by 0.75% with an update on stories elsewhere. With your Bloomberg Brief, it's Danny Berger. Hey, Danny.
Hey, John. President Trump said that he will attend a meeting with Japan to discuss tariffs, military support, and trade fairness today. In a post on Truth Social, Trump said that U.S. Treasury and Commerce secretaries will also be in attendance. Japan is one of the first countries to negotiate the levies. Elsewhere, Russia has asked the U.S. to let it buy Boeing planes using money from billions of dollars in frozen state assets. Sources tell us that Russia understands the frozen funds can't be used until a Ukraine ceasefire deal is reached. The deal could form part of sanctions relief if and when there's a ceasefire. Meta CEO Mark Zuckerberg taking the stand for a second day in the FTC's antitrust trial, saying in 2018 he considered spinning off Instagram over concerns that it was overshadowing Facebook. He also acknowledged that he thought Meta would be broken up over the next 5 to 10 years and considered strategies to avoid such an outcome. He's expected to testify again today. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the program, Airlines navigating with limited visibility.
The effect of the current trade negotiations is here in inbound travel to the United States. Certainly there are things in the air, right? There's the fear of inflation, recession even.
Up next on the programme, we'll catch up with George Ferguson of Bloomberg Intelligence, live from New York City. You're watching Bloomberg TV. Equities negative here. We're down 0.75% on the S&P. Chip stocks weighing on the equity market worldwide. On the Nasdaq, some underperformance. We're down by 1.4%. In the bond market, some pretty good news for you. Yield's still lower. We're down about 3 basis points at the front end of the curve. We're stable on a 10-year maturity, 432.91. Two things to look for a little bit later. 8:30 Eastern Time, we'll get US retail sales, the consumer very much in focus. Then 5 hours later, 1:30 Eastern Time, speaking to the Economic Club of Chicago, the Fed Chair, Jay Powell.
What's he going to say, given the fact that there's so much focus on bond market dysfunction that's going to force the Fed to step in? Is he going to reiterate what Chris Waller said, which was essentially that they will think about cutting rates in the face of real weakness? And then how much weakness do they need to see? Because right now, at least in the earnings, we're not seeing dramatic weakness that looks like it's going to show up anytime soon.
I'll do what United Airlines did.
Please do.
I'll give him two options. He can do a Governor Waller or a President Kashkari.
Ooh.
Pick your poison right now.
There's no way he's going to do either of those. Those are the two polar extremes. That's basically saying our earnings are going to go to zero or our earnings are going to go to $1 million.
The chairman's prioritising coming out, and I think for optics and communication purposes, pledging to anchor inflation expectations. That seems to be the focus. I'd be surprised if that changed in this address.
I would agree, and part of the reason why is game theory. It's this idea that if they signal that they are going to cut rates, then the market's going to move and make it more difficult for them to actually achieve that inflation expectation stability that they're looking for. So don't expect fireworks, don't expect anything that's particularly market moving. And right now, it really is about watching the earnings and understanding when the soft data will start to trickle into the hard data, or whether this will be a divergence for the ages that will get looked back on as a big ultimate head fake.
Just how are we going to close that gap in the coming months is a huge question. Under surveillance this morning, let's talk about the airlines. Airlines navigating with limited visibility. So here's the latest. United Airlines shares are up after the firm took the very unusual step of offering two possible earnings scenarios. Bloomberg opinion columnist Mohammed Al-Arian posting on social media, the United's move highlights why it's important to think in terms of multiple scenarios for internal planning and not just stick to the usual in this macro environment. Joining us now to discuss is Bloomberg's George Ferguson. George, welcome to the program again. Let's talk about this very unusual approach. Why do you think they came about with this?
Yeah, I think it is because of the unusual times. I mean, if you listen closely to the Delta earnings, the Delta management talked about all the things they were worried about, but most of them were not yet manifesting themselves. And so I think we're going to hear more of that today from United. We're going to hear about worries from tariffs. We're going to hear about worries from the stock market swoon and what it's doing to their consumer. But my guess is they're not seeing a lot of of the effect yet, and maybe even concerned or cognizant of the fact that this tariff negotiation may not go on for a full year, may go on for a couple months, and so I think it's stretching their ability to give visibility on the profit outlook for their companies, and so in this case I think they've gone to two scenarios.
How different is the outlook for United, for Delta, even for American versus the Southwests of the world or the JetBlues of the world? How much can some of the largest players really exercise their heft and their resilient balance sheets to gain market share in a time of uncertainty?
I mean, in a time of uncertainty or a downturn, you always turn to the best balance sheets, right? They always give you the most distance, I guess, to the door or to significant problems. And in the U.S., that's Southwest, that's Delta. But look, I think that going into a potential downturn here, my guess is that you're going to see the higher end consumer hold up better, and that's really what's been helping United, American, Delta outperform. And so I think that puts them in better stead going into it. Again, a downturn that probably going to affect the lower end consumer more.
There's a question about pricing as well, implicit in both Delta and United, saying that they plan to cut capacity later in the year. How much are they planning to get ahead of any decline in demand and essentially reduce supply to keep pricing where it is?
I mean, it takes time, right? And so I think that's why you saw United say they were going to start to cut in 3Q. But, Delta went a bit further and they said they were going to flatten growth, right? No growth for the back half of the year. So Delta a bit more aggressive. I think Delta, one of the challenges there is they're more of an Airbus shop. And so they've got to be, they bring more of their fleet is Airbus focused. And so they'll be, they don't want to really bring airplanes in right now. They said it outright and pay tariffs on it. So Delta may have a bit of a disadvantage and therefore may not be able to bring in the capacity they want. Now, we've been watching fares. We watch yields, which is price paid per mile flown. And what we've seen is they've been edging over, even since the end of last year. So we're not surprised, I think, that pricing here, it looked a little softer to us. It's better at the big full service carriers. So as we get into low cost, we'll see even more what it's doing to the low end consumer. But it was soft again before tariffs. So we do think capacity has to come out of the marketplace to firm up pricing.
George, you just mentioned Airbus. Are they sent to win in this tit for tat when it comes to Beijing and Washington, based off the news that China is now halting deliveries or their airlines to continue ordering Boeing jets?
So I don't think so, right? And so we have a report that's going to come out in a couple of days. I've been watching it closely, right? And so there's a couple of things. One, I would say the Chinese announcement that they're not going to take any more Boeing airplanes is more headline than anything, right? So when we look at orders from Chinese airlines for Boeing aircraft, there's some 240 or so orders on Boeing's books. Only 16 of those orders have been placed this decade. The majority were placed in 2018 or previous. The Chinese really have sort of put Boeing in the penalty box for a while and not placed orders. So I think that's, they've just finally admitted that. And, one of the things we look at is we look at the tariff, issue. One, I would say Airbus has a lot more customers in the U.S. than Boeing has in Europe. Boeing has a core Ryanair customer in Europe. That's their most important customer there. In the U.S., Airbus has Delta, Airbus has Frontier, Airbus has Spirit, Airbus has JetBlue. Those are all core customers. And so when we added up the number of aircraft in fleets and the number of aircraft on order, it's very even in the US, Airbus and Boeing, and it's tilted for sure to Airbus in Europe. And the other thing we're thinking about right now is, as the administration gets into some of these negotiations with trading partners around the world and asks them to equalize their trade, one of the things that probably is going to be on the table is going to be buying more Boeing aircraft. And so Boeing lagged last year in book to bill and the number of orders they took in. As they start to build more airplanes this year and confidence is restored in the company, I think you could see some Boeing sales, on the back of some of this tariff discussion.
You touched on the major issue. They've got to build them. George, appreciate it. George Ferguson there of Bloomberg Intelligence. George, thank you. Let's wrap up earnings season so far. The financials have projected confidence, and United Airlines just not as bad as people thought it would be based on the guidance some of these airlines gave us a few weeks ago.
To me, the big story is that a lot of these companies, to the extent that they've got visibility, it's pretty darn good. And they're looking at a potential outlook that shows a resilient consumer at a time where people are worried about a downdraft. More than half of S&P companies that have reported earnings in the past month have maintained guidance. The rest of the half is split between raises and cuts. So it's not this Armageddon, at least in earnings.
I don't know where we're going, but starting points matter. And the starting point for corporate America is pretty decent based on what they're telling us. Coming up next on the programme, we'll catch up with Alicia Levine of BNY Wealth. We'll speak to Bloomberg's Tyler Kendall, the former House Majority Leader, Eric Cantor, and Alan Ratner of Zelman and Associates. From New York, the second hour of Bloomberg Surveillance is up next.
In the near term, I think the risks are still elevated.
It is the calm before the storm.
We have been seeing this weakening in the economy, a very gradual weakening.
The soft data is telling you that the hard data is likely to weaken.
What we are actually going to see is probably slow deterioration in the growth trend.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, with equity futures on the S&P negative by 0.75%. Chip stocks weighing on this equity market. We'll get to that story later. On the Nasdaq, some underperformance, down by 1.4%. Speaking of the story we'll get to later, 8:30 Eastern Time, 90 minutes away, US retail sales. We know how the consumer feels. It ain't great. What have they been doing? Retail sales drop later on this morning. And then after that, you'll hear from the chairman of the Federal Reserve, Chairman Powell, at 1:30 Eastern Time, the chairman on the U.S. economy.
And how much is he going to reiterate the sense that they are going to address weakness in the economy? The bigger question is, will they see weakness in the economy anytime soon? Bob Elliott at Unlimited Funds put this out on X that I thought was really interesting. The soft data can't get much worse, so its impact on markets is limited. It seems it'll require weakening hard data to convince the markets that growth is on a path to decelerate meaningfully. People are still waiting for that Fed put. Question is whether the data will work in their favor.
In the last few weeks, Lisa, as you know, we've had a loss of confidence in US policy. To repair that, we need to see some evidence that negotiations are happening and that they're fruitful. This is what we heard from the president earlier on this morning. Japan is coming in today to negotiate tariffs, the cost of military support and trade fairness. I will attend the meeting along with Treasury and Commerce secretaries.
Well, this really just reiterates what Secretary Bessent had said to me about trade negotiations, was that is going to start from the top, and any negotiation the president is going to sign off on. Now, Donald Trump is taking it an even another step. He's going to be entering a meeting with individuals below him. These are trade negotiation teams, but he wants to be in the meeting. So you see the direction of travel when it comes to a process that's taking place when it comes to trying to get these deals. At the same time, you see headlines drop that Governor Newsom is going to sue over what this administration is doing with tariffs. A lot of tension now brewing when it comes to trade.
That headline just crossed in a Bloomberg terminal. I'll share that with you again. The California governor, Gavin Newsom, saying the state will sue over Trump's tariffs.
And we were expecting some sort of lawsuit, particularly from Gavin Newsom. A real question here going forward about how much some of these tariffs are going to get caught up in the court system, given the fact that people are questioning the IEEPA statute, how much this has to do with national security, and just how much power the president can take. This, again, prolongs the uncertainty because what will actually get done in the court system will take some time.
Very different what you're hearing from Governor Newsom, who's talking about the three major export hubs being Mexico, Canada, and China, as it's going to impact their economy. Then when you heard yesterday around the table when you guys sat around with Governor Youngkin, we can deal with this and we need to reset trade imbalances. Depending on the governor, I think it really depends on if you're from red state or blue state.
It's pretty tiresome to deal with right now, let's put it that way. I'm sure you will feel the same way. Equity futures on the S&P 500 negative at the moment by 0.8%. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth on China coming to the table, the former House Majority Leader Erika Cantor as Wall Street looks for policy stability, and Alan Ratner of Zelman and Associates on the state of the housing market. We begin this hour with stocks recovering on signs China might be willing to engage in trade talks. Alicia Levine of BNY Wealth saying the administration's Let's Make a Deal show removes the worst-case tariff scenario. The market can only inflect higher with a policy response. There will be equity vol as long as there is policy uncertainty. Alicia joins us for more. Alicia, good morning.
Good morning.
There's certainly a lot of that going around.
Yeah.
Are we addressing any of this?
Look, I think, you know, as I've said, like, time is not on the market side and time is not on the real economy side. The longer this gets drawn out, you're doing real damage as corporations and individuals are sort of frozen in place, waiting for what the actual policy is. So the interesting thing about the 90-day pause and the recategorization of some of the electronic tariffs is that it does remove some of the left tail risk in the market, but it doesn't really remove the left tail risk in the real economy, which is getting damaged every day. So at first we were optimistic on that 90-day pause like everybody else. And then when you start thinking about what this actually means, it means it's going to go on for much longer. So Q1's going to come in fine. You had pre-buying before tariffs, and the hard data, as we've talked about, has held up fairly well. The soft data is rock bottom. And again, you know, where can this go from rock bottom, right? So you're there. In fact, we did a chart for our team about, you know, what happens when consumer sentiment hits rock bottom. Well, it turns out the S&P tends to rally right after that. And we went back about 40 years with this. So, you know, the soft data is not telling us anything that we don't know. But we're here, and you know the concern really is that unless you start seeing the outlines of what a deal looks like with Japan, with the broad outlines, yes, details can take 6 months, 12 months, but what does it look like? that would further remove left tail risk on the market. And I think here you're fairly priced. You're fairly priced at about 5,400 for where earnings are going.
8:30 Eastern Time. US retail sales. US retail sales for March. Is it too early to expect some weakness to show up in those figures?
Given the fact that the sentiment data was already cratering in March, if there's some read through, you should start to see something going on. I find what's fascinating actually is the fact that tariff is on everybody's lips. The American public, which tends to tune out a lot of political stuff, is talking about tariffs everywhere. And so everybody knows about it and concerned about it. And of course, it's the inflationary piece that everybody's worried about because we just lived through bad inflation 2 years ago. And so that's the biggest fear here. But sales probably represent some pre-buying.
What do you need to see to try to get more confidence in some sort of risk rally? And I say this at a time where we do have a number of earnings that are coming out pretty positive. UBS's CIO came out with a list of 5 reasons why they actually are getting pretty positive for U.S. equities in a 6 to 12 months basis. And they include April tariff showers, May fiscal flowers. This is really fun. The Fed put and the data by U.S. exceptionalism, especially when it's on sale. That last point, do you think that the divergence between the U.S. and the rest of the world has been overplayed?
Totally. I think it's been totally overplayed. Meaning the rest of the world, we are the buyer for the rest of the world. We have the best consumer on earth. It's 70% of U.S. GDP. The consumer can be down, can take a break, but ultimately this is what drives the global economy. And if there is concern about where U.S. policy is going, well, boy, the rest of the world really has an issue here. That doesn't mean the rest of the world can't outperform this year in some sort of catch-up trade as some of the heat from the tech sector comes out on the multiples and the S&P resets here. That's perfectly reasonable. But if you look forward for the cycle where this is going, I struggle to accept the fact that the rest of the world will be growing faster than the U.S.
At the same time, people talk about the response to tariffs from the U.S. and it comes to fiscal spending. You've seen that in the U.S., you've seen that in Europe, you've seen that in Japan, you've seen that in China. Why can't you just follow the fiscal spending at a time when a lot of people are saying that tariffs will hurt the United States as much as some of these other trading partners?
So the fiscal spend is a great story as a trade. In the end, we do long-term wealth creation. We do long-term wealth preservation. So that for us would represent, a nice trade for the next 12 months. That's probably the right framework to look at it. But if you look at how the markets have performed since Liberation Day, actually the U.S. has outperformed the rest of the world with the understanding that the U.S. is actually in a better position here than the rest of the world, specifically on the trade issue. So fiscal can only get you so far, as we've seen in the U.S. You can prop up the economy for a couple of years, and then you really have to deal with the underlying productivity and barriers to growth that you have, for instance, in Europe, that you have to deal with. So they're going to put $1 trillion into the economy. How productive will that capital be? Right? Where are the regulations going?
Trying to get some visibility on policy down in Washington, and now we've got legal issues. So if you're just joining us, I want to share this story with you again. The California Governor Gavin Newsom has said his state is suing to halt President Donald Trump's tariffs, citing harm to consumers and businesses. Harm to consumers and businesses. Now, this is something people have been talking about for a while. Is that enough to say you've got a legal footing to push forward and really stop what's happening here?
Well, I think given the fact that the United States, the administration has come out and said that this is due to IEEPA, a national security concern, that likely that will be upheld in court. And I think this is one of the things that Jamieson Greer, the USTR trade representative, has been very focused on, making sure that anything they come out with can legally be upheld in court. But the courts are going to fight it out. And certainly Governor Newsom, I think, eyeing maybe a 2028 bid, is going to do whatever he can to try to make this point very clear.
This is almost exactly what Libby Cantor of Pimco said to you and I on Sunday evening. This is what she was anticipating, these kind of things, and this is the first, and I'm sure it won't be the last.
And this is ultimately the real question with exemptions. How much does that open up the Trump administration to legal challenges based on the fact that, is it a national emergency or not? There has been a lack of direction in terms of exactly why some of the tariffs have gone on, which might go to some of the legal fight. That said, even if they do get undermined, there are other provisions that this president can use to try to get these tariffs through. So again, the whack-a-mole of tariffs, it's not going to go away. It's just going to get dragged out in a court system.
Alicia, everyone's become an expert in trade relations, and now they need to become an expert in trade law. As an investor, how do you navigate this mess at the moment?
Really difficult. Really difficult. Look, I think with the VIX at 60 and the S&P hitting about 4,800, that's typically a signal to close your eyes and buy, because your downside from 4,800 in the worst case scenario is probably a 4,400 or 45. Worst case scenario, like deep recession, earnings get cut to 230 or something like that. Is probably a 44 to 4,500 from 4,800, and it's asymmetric risk to the upside there, particularly when VIX hits 60. So we're looking at technical analysis for that kind of thing. The 200-week moving average on the S&P, which is held for about 50 years, is at 4,600. So 4,800, you've essentially de-risked it. The only time the S&P went below the 200-week moving average was during the depths of the global financial crisis. And then it popped right, and every crisis, you just hit it if it's bad enough, and you respond from there. So that's what we're looking at. Here at 5,400, again, where we think earnings are going, which, it'll come down over the street, you're probably fairly priced for now for the kinds of uncertainty, very difficult to model. I think it's really good to remember, though, there's also right tail risk. We all sit here and talk about the left tail risk. We can't model it. It's a terrible policy. It's inflationary. It's stagflationary. We're going to go into a deep recession. But there's also the right tail. And I think in markets, there's always a two-way trade. And I think now you're starting to get the conversation about, okay, what could the upside look like? And I think we need to remember it.
I'm glad you mentioned the VIX, because the Treasury Secretary mentioned the VIX in my interview on Monday, and he said it's likely peaked and it's spiked. Do you agree with him? We're past it, or you think we could see the VIX spike again?
On a probability basis, we've probably spiked. There can't be any certainties here. What I do know, when the market's down about 20% and the VIX is at 60, I have better odds than not in deploying capital at that point. And so that's what I would say. I'd say the real risk here is there some kind of financial contagion, right? The bond market and the FX market have moved so quickly, acting like the equity market, frankly. What's out there that we're not seeing that's leveraged that could create a broader financial risk? If this is a policy-induced error and a policy-induced sell-off, those can be fairly quick. Maybe you have a bit of a U-shaped recovery, but more or less we're intact. The issue is if this becomes a financial contagion. So yes, VIX at 60 should be a buy signal. The S&P at 4,800, more risk, to the upside than downside. Still downside risk, but your asymmetric risk. It's really the financial contagion issue. We don't know. We don't know. That's what we have to think about.
Alicia, you're going to stick with us, I'm pleased to say. Alicia Levine there of BNY Wealth. We've had negotiations, exemptions, and now we've got legal challenges.
Which just goes to prolonging this whole process. If you're looking for clarity, get used to not having any. That said, at least there is a sense that there is no room to negotiate, is actually room to negotiate, and that those negotiations are underway.
Equity futures on the S&P negative by 0.8%. With an update on stories elsewhere, with your Bloomberg brief, is Danny Berger. Hey, Danny.
Hey, John. First, the details of that breaking news on the lawsuit. California Governor Gavin Newsom saying the state will sue over President Trump's power to enact unilateral tariffs. The state is seeking an order that would immediately block the tariffs. Newsom cited harm to consumers and businesses in California. Trump is already facing at least 3 legal challenges to his trade policy. Elsewhere in trade policy, President Trump has said that he will attend a meeting with Japan to discuss tariffs, military support, and trade fairness today. In a post on Truth Social, Trump said that U.S. Treasury and Commerce secretaries will also be in attendance. Japan is one of the first countries to negotiate the levies. Chinese shopping giants Temu and Shein saw sales surge in March and April as U.S. shoppers stockpiled products before tariff-led price increases. It also follows a February where both companies posted their slowest growth of the past year. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny later this hour. Up next on the programme, pushing for China to come to the table.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. They need our money.
A very subtle sign that China might be ready to come to that table. Up next on the programme, Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Snapped a two-day winning streak on the S&P 500 in yesterday's session. The declines continue on the S&P. We're negative here by 0.75%. On the Nasdaq 100, we're down by 1.45. Three things to watch a little bit later. Down in Washington, D.C., look out for this. Trade talks between the United States and Japan. And the president telling us this morning he will attend those talks. Later this morning, 8:30 Eastern Time, U.S. retail sales. And then Chairman Powell addresses the U.S. economy at the Economic Club of Chicago at 1:30 Eastern Time. Just keep those things on your radar. Under surveillance this morning, pushing for China to come to the table.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants what we have, the American consumer. Or to put it another way, they need our money.
So here's the latest this morning. The team here at Bloomberg reporting that China is open to trade talks if the White House shows more respect and is willing to address their concerns on Taiwan. To discuss is Bloomberg's Tyler Kendall. Tyler, busy morning already. Negotiations potentially with China, and they're going to happen with Japan later. And then the prospect of a legal challenge out of California.
Yeah. Hey, John, a lot going on here, a lot of different levels to this as the administration pushes forward with its tariff plans. And we're learning, as you've mentioned, that a person familiar with the Chinese government's thinking telling Bloomberg News that the most important precondition for talks is that Chinese officials feel that they will be treated with respect. It appears that Beijing wants to start to see President Trump disavow comments from his cabinet members when they are critical of China. Now, you mentioned there President Trump saying in the last hour that he is going to be engaged directly with Japanese negotiators. We're learning that China wants to see the U.S. instead appoint a specific point person that can act and speak in President Trump's capacity. Even as the White House says, President Trump wants to and will be involved in these negotiations directly. President Trump's meeting today, he's going to be alongside the Commerce Secretary Howard Lutnick, as well as Treasury Secretary Scott Bessent, who told Annmarie earlier this week that negotiations with China can be particularly tricky, considering that China is both an economic competitor but also a military rival. And you heard President Trump say in his post on Truth Social that they are going to also be talking about those national security and military matters in these conversations as well. Because, John, well, tariff barriers against China have now reached, of course, record highs. We're going to start to hear a lot more about escalation when it comes to those non-tariff barriers. Take, for example, China looking to both restrict but also in some cases completely suspend its exports of critical minerals to the U.S. And just yesterday, the U.S. formally announcing that Section 232 investigation into critical minerals and rare earths, the latter of which the U.S. imports about 70% of its supply from China, was widely seen as a move to try to pressure Beijing to the table.
Tyler, what can you tell us about Gavin Newsom's new legal challenge to the president's tariffs?
Well, it appears it hasn't been filed quite yet, the complaint, but it does appear that Gavin Newsom is trying to make this argument that the tariffs against Mexico, Canada, and China, that initial batch, are harming consumers and businesses. We should say that, of course, this is coming as a challenge to how the president invoked IEEPA, the International Emergency Economic Powers Act, and we've actually have seen some other lawsuits against this when it comes to the so-called reciprocal tariff plan on two bases. One, that the emergency invoked for that, which would be the trade imbalances, doesn't rise to the level of a national emergency. In this case, it would appear that California is saying that the fentanyl and immigration might not rise to the level of the emergency. And then, of course, the second part of this is that IEEPA actually doesn't explicitly state that tariffs can be invoked. So those are potentially two legal paths that we could see happen here. But we should also importantly say that in the past, the courts and the justice system has really broadly given presidents the authority to invoke national emergencies and often sides with them in these cases.
Hey, Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. Thank you. We had this conversation a little bit earlier this morning. Let's just sit on the U.S. and China. The prospect of China coming to the table, even if they do, it could take a long, long time, way more than 90 days, to come up with an agreement with the Chinese.
Which raises this question, do you just keep getting a pushing back of some sort of negotiating timeline? Or is there going to be some real disruption in the meantime that you're already seeing companies gird for in terms of supply chains and trying to stockpile goods?
Alicia Levine of BNY Wealth still with us. Alicia, let's get to this. If you don't know how long talks are going to last, what do you do in between? We keep hearing this phrase, wait and see. what kind of CapEx decisions can you make in the meantime?
So we're very concerned about that because already intentions to invest and intentions for CapEx have dropped. If you look at all the survey data, that's what we're seeing. So it's a pretty brutal policy in terms of forward investment. And that's really where the problem is coming, that each day that this goes on and time is just not on the side for the real economy, just as a reminder, the market always bottoms before the real economy does. It happened in COVID. It happens all the time. It's just to remember that that's out there. But there is real damage happening today, right now. It's great that China and the U.S. are negotiating, but it's impossible to make a decision if you're a COO or a CFO where to put investment. It's impossible. And so I'm concerned that you might have a freezing in the real economy here. I think the risk is real, and I think it's happening right now. And certainly the damages to small businesses are beyond, right? So the interesting thing, the challenge from the governor in California is really the first major IEEPA challenge that we've seen since policy was announced on April 2nd. So it's actually amazing that there haven't been more. It hasn't been immediate, but I think the administration knows that IEEPA is a little bit more on shaky ground, which is why they're putting pharmaceuticals and semis under 232, right?
There's this other question. It's not just how this trickles out into the actual economy. It's, are there certain sectors that are going to be so exposed so as to be not really desirable for you? I'm thinking of auto manufacturers or retailers.
Yeah, look, but for that, in terms of an investment thesis, you just really have to look at how far the stocks have fallen and where the multiples are. Because there is a price at which you pay because it's been completely de-risked. So the auto sector looks like it's been completely de-risked here. The market's very efficient in pricing it with the worst case scenarios, and I think we have it. Again, we have to remember the markets always bottom before the real economy does. So sentiment data has been rock bottom really for about 5 or 6 weeks now. Again, the American public knows the word tariff, which I find fascinating because sometimes they don't know who the defense secretary is. And so we've seen the sentiment data really be terrible. The issue is, can the hard data at this point declining do more damage to markets than what we're already anticipating? And as investors, that's where we have to live. We've gone neutral on equities. We've moved some of the allocation to short-term fixed simply because we too are really uncertain. And it's very hard to have conviction except on price and valuations.
President Biden forgot who the defense secretary was once upon a time. Do you remember when we lost him? For about a week.
He was lost because he was under anesthesia. Yeah, that's right. And then he didn't call the White House to tell them he was going to be under anesthesia. So, yeah, I think it was 24, 48 hours.
Is that how long it was?
We lost the defense secretary.
Got to find space for jokes here, Bramo. Alicia Levine of BNY Wealth. Alicia, it's good to see you. As always, thanks for dropping by. Up next on the programme, we'll catch up with the former House Majority Leader Eric Cantor as Wall Street looks for some policy stability. Are we getting signs of things just kind of cooling down? Just a little bit. Equity futures on the S&P 500 at the moment negative by 0.8%. Lisa, in focus this morning, the chip makers.
Yeah, and how they can really withstand some of the uncertainty that's ongoing, even as they prepare for the ongoing restrictions. That's not good enough, as we learned from H20 over at NVIDIA.
In just a moment, Danny Berg will break down some of the movers in the pre-market. Live from New York City, you're watching Bloomberg TV. The chip makers in focus this morning. Equity futures negative across the board. On the S&P 500 down by 0.75%. On the Nasdaq we're down by 1.4%. With your movers going into the opening bell about 2 hours away. Here's Danny Berger. Hey, Danny.
Hey, John. And here's that company that's causing the rupture in chip makers. It is NVIDIA this morning, down 6.33%. Reporting yesterday that they would be taking a $5.5 billion charge because their H20 chips, remember, these are the chips that they specifically designed in order to get around export controls to sell to China, are now being targeted by the Trump administration and are now themselves facing restrictions. So a big blow from them, bringing the entirety of the sector down with them. Meanwhile, you also have United on the upside this morning, up 7 1/3%. Maybe this is the new playbook for companies that are uncertain to their future. They keep their outlook for the year, earnings as high as $13.50 a share, but they say in the scenario where there's a recession, it will roughly have to about $7. You can see the positive share reaction. That contrasts with Delta, Frontier last week, who completely upended, got rid of their outlook for the year, and those shares fell. But this morning, it's a positive story for the airlines. It is lifting the rest of the sector with it, given that it's given the market a floor. Rounding things out with the Reuters report this morning on Tesla, sources there telling the outlet that Tesla will stop importing products and parts from China for their Cybercab and for their semi-electric truck. Those shares falling 1.9%. It hurts their efforts to really mass produce these things. It will be on pause for an indefinite amount of time. Again, sources there saying that they could handle the 34% tariff on China, but at the current levels, they just can't absorb the costs. John.
Danny, thank you. Tesla down by about 1.9%. On our radar this morning, China signals it may be willing to come to the table on trade. Sources telling us here at Bloomberg that Beijing is looking for certain conditions from the Trump administration, including a more consistent position on trade.
And also a little bit more respect they're talking about. They want to rein in some of the comments, like I imagine what they're talking about is what we recently heard from Vice President J.D. Vance talking about Chinese peasants. Interesting, though. They want, Jonathan, what you said Wall Street wants, what Jamie Dimon wants, a point person to do these negotiations. Scott Bessent, the Treasury Secretary, said to me they will start from the top. Before you get a meeting between Donald Trump and Xi Jinping, there's going to need a point person to try to bridge the gaps in terms of a trade deal, especially when it's more than just trade. It's things like TikTok that might come into the discussion in the negotiation.
If the Japanese negotiations are a template for what's to come, it's going to be President Trump with Scott Bessent and Howard Lutnick all in the room at the same time. If you need a note taker, I will take notes. I will just sit there quietly. I would like to watch. I am curious how that's going to go.
I think it's going to be very interesting, given that there's one man that this market would like to see more of, and another man that this market might want to see less of in the coming weeks.
The market wants to see more Scott Bessent. They are very happy that now he clearly is in the driving seat when it comes to trade negotiations. I asked him, he had told me after Liberation Day, Jonathan, that he was not part of the negotiations. He clarified to me this week that he didn't mean he wasn't part of the negotiations. He wasn't part of setting the tariff rates. It was a signal that he is now in the driving seat to bring these tariff rates down. I have to say, though, if I was part of the Japanese negotiating team today, I'd be very nervous. You're going in with the President of the United States, not your direct counterpart. And I imagine the Prime Minister feels a little bit left out.
It's probably not what they were expecting, that's for sure. Love the conversation you had with the Treasury Secretary. Could sense the frustration he had that the overwhelming focus of the press at the moment was only on one stall of the policy platform. So let's talk about another leg of that stool. Let's talk about the GOP, considering a new tax bracket for millionaires. Sources telling us here at Bloomberg that House Republicans are proposing a new 40% rate for taxpayers earning over $1 million a year. The White House officials saying the president is actually open to the idea.
They're open to this. You have Senate and House aides and White House aides talking about this. They're drafting it. One thing is key, though, in our story. This White House official said that Trump is open to this idea of a new tax bracket. However, there was an emphasis that the higher rate should kick in at a threshold far greater than $1 million. And to be honest, this is what I've heard from people. Maybe there's a new tax bracket, but for people that make hundreds of millions of dollars, not just that 1 million threshold.
I'd love to know how many people earning hundreds of millions of dollars will actually pay that, because I imagine they had an army of accountants doing their tax returns. They don't do their tax returns like we do our tax returns, right? They've got an army of people working on those things.
Yeah, they'll deduct the factory that they built to fuel their kitchen and the house that they built and then the other house that they built. Look, the fact that this is being proposed highlights the perennial issue, which is that everybody has a money problem in Washington, D.C. You need more of it because right now deficits are going up, and the proposals that they have would only deepen those deficits.
A couple of things to watch later this morning. We talked about retail sales. That's due in about 60 minutes from now. Also this from Fed Chair Jay Powell, 1:30 Eastern Time from the Economic Club of Chicago. His second public appearance since President Trump unveiled sweeping tariffs on April 2nd. Will this address be any different?
You know, at a time when you're hearing from other Fed officials, there is a real debate about how much this Fed is going to raise concerns about anchoring inflation expectations versus going after some perceived weakness as you see a bottoming out or rock bottom types of sentiment in some of the soft data. Very difficult one. it is also difficult to take anything completely literally, considering that he is also messaging to a market where he wants them to believe that they're going to take a very firm hand when it comes to inflation.
The Fed chair speaking at 1:30 Eastern Time. Let's get to this. Wall Street's biggest banks looking for some clarity on policy. JPMorgan's Jamie Dimon urging Trump to start talks with China and telling the FT, quote, "We should be careful. I don't think anyone should assume they have a divine right to success and therefore don't worry about it." Joining us now to discuss, the former Republican House Majority Leader, Eric Cantor. Eric, welcome to the programme, sir. Welcome back. It's good to see you.
Nice to be here, Jonathan.
Let's reset. What do you make of the approach from the administration to trade over the last few weeks?
Well, listen, I mean, there are so many, there's so much noise, so many signals coming from the White House right now. I think that market players are just, sort of trying to take a step back and figure out if they have a portfolio of companies, what it is that they look like, if they're import sensitive. Obviously, there's now a little bit more focus on what's coming out every single day of the White House. I think the imperative for the president and his team today, as they're meeting with Japan, is to demonstrate success. I mean, this is where I think people are looking for some amount of clarity in that. What does it mean when we're supposed to be enduring some pain? And the president's been pretty clear, saying, "Hey, we're going to change sort of the trajectory of the country. We're going to strengthen the foundation." And if that's the case, what does it really look like when he's dealing with a counterparty? And if it's Japan, and I would say even India, because India is the one that is most protectionist that comes to mind. If we can demonstrate there's an opening up of that markets, that this is what it's all about, I think that would calm some nerves right now.
Are you convinced that is the metric for success?
Well, I think, there is, Alicia, you talked about sort of taking him literally, taking him seriously, or hinted at that in what you just said. And I look at this term of the Trump administration somewhat differently than the way we looked at the last one, in that almost he is sticking to his literal word when we're talking about tariffs and trade here. So, Jonathan, back to your question, if he's about trade deficits, because that's been one of the real metrics that he's put out there consistently, that's what it's about. So are we going to see the Japanese buying more of our goods? Are we going to see that along with the opening up of their markets so that our exports can flow into these other countries?
The president ran, though, on getting everyday goods down in prices, things like groceries, things like gas. A recent CBS poll says a majority of Americans see tariffs adding to prices, adding to inflation. Can they wrap this up before the midterms? Well,
this is and then this brings up the last point I think that's really important about today, and when we look at Capitol Hill when Congress gets back. I think the administration and the Republicans need to act with dispatch. It's important that there is some success under the belt demonstrably, so the markets see that in terms of dealing with countries. And I think from the Republican standpoint in Congress, they've got to get this reconciliation bill done. Simplicity is their friend right now. Adding additional taxes, doing those kinds of things is going to take weeks, if not months, to bring everyone on board. And I think if we can just extend what President Trump had said was the greatest tax bill ever, 2017, they should just go ahead and do that.
If I had said to you, Congress right now is debating whether or not to raise taxes on people that make $1 million a year, would you think that came from a Republican or a Democrat?
It is an extraordinary concept coming out of what I believe is still a very pro-growth party. I think you've been discussing this morning, the three legs of the stool of the Trump economic plan. One of them is taxes, the other deregulation, along with the trade agenda. All that has to come together to help growth in this country, to see incomes rise, wages, growth, wealth, all of it, opportunity. And to sit here and say that we are going to be increasing marginal rates on individuals, that ends up hurting small businesses. I mean, that's the trick there. When they start talking about millionaires, remember, we've got a lot of people in this country that file taxes that have sub-S or LPs or that are taxed at the individual level, but actually run businesses. And I don't think they're going to get too far with that concept.
But what if they do? This is a pillar of conservative orthodoxy, not to raise taxes, period, on anyone. What do you make of the party and the direction of travel if they were to go ahead with this?
Well, again, I'm not sure that they're going to go ahead with this.
But they're discussing right now.
Well, I'm not so sure how widespread that discussion is and what kind of enthusiasm there is. But this is not a pro-growth item, and I think more of the focus is going to be on how they come together on these pay-fors, because we saw, again, the important data point that occurred last week was the bond markets. You know, we saw the concern there about the fiscal health going forward. And I think it's really important they focus on that so they can act with dispatch and get these tax rates extended.
Heading into this year, the belief was that President Trump was going to be a pro-business president who is going to focus on fiscal responsibility as well as celebrating national champions. We have seen policies that have reaped the opposite consequences in markets. Do you think that this president is still pro-growth?
I do think he's a business guy. I mean, we all know he's a real estate developer from New York City that was very successful and had times here where, just like any in the real estate business, there are ups and downs. But he has demonstrated the ability in business to create wealth. And I think he wants to do that for America. And so, yes, I think he is. Now, what he's going about doing in reordering our economy and trying to sort of rebalance, if you will, the balance of trade, as well as the burden sharing that occurs with us and our allies, importantly in the financial realm as well as the defense realm.
Although you have a unique position because you wear the hat of both being in government, in a leadership position, and also talking with tons of companies while being vice chair of Moelis. Do they have the confidence to invest? Do they feel like they can be expanding right now and have confidence and conviction that ultimately this whole mix will benefit where they're heading?
Well, I mean, I would say, first of all, we're still America, right? I mean, there is still this unbelievable country that we've got with, and we can go through the various aspects of what draws capital and investors here, rule of law, transparency, you name it, innovation, the rest. We're still that. The Trump administration understands, and the president in particular has said the biggest asset we've got is this huge consumer market that the world now has tooled up to take advantage of. And he's trying to use that to go in and create a more stable trajectory longer term, both from a fiscal and economic standpoint. So I think, listen, right now, as we started, there's a lot of signals that are creating this sort of question on the minds of individuals, whether they are strategics, whether they are sponsors, and how to go about in terms of conducting their business. And that's why I say, again, really, really important that we see manifestation of success. The president's really good at communicating. I hope we can see some communication of success. And that people will begin to understand what the trade-off here is.
This is ambitious stuff. Let's finish on this. Governor Juncker was in your seat yesterday, and we asked him this question. I'll phrase it differently. At the moment, there are two very left-wing politicians in this country filling stadiums, getting support, at a time when the Democratic Party is an absolute mess and support is rock bottom. I get that. But do you worry that if the president isn't successful, that in a number of years' time, this pendulum could swing aggressively to the left? If the right can't provide the solutions, does this country seek out solutions from the left?
Look, all I know is the left is so in tatters, and the one pillar that they've got of any kind of unity is so extreme on the cultural side and the design of where they see the world. There is no way that the mass of this country in terms of an electorate is going to adhere to that extreme Bernie Sanders AOC agenda. There is just no way. Now, not to say that there will be unhappiness if we don't see success, again, which is why I come back to the point it's important that we act with, that we see some urgency and acting with dispatch in Washington.
Because you understand the risk here. To bring up the EM example, that you swing between Bolsonaro and Lula, and you start to resemble what we see in Latin America repeatedly.
We are America. We are America. We are not Brazil, right? So we have a long tradition of continued institutional guardrails, protections. We have the deepest, broadest capital markets there are. I still believe that we can get through this. Again, as you said, this is a very ambitious goal that the president has set out to sort of rebalance. It is where we can head, and the fact that there have been some people left out. Yeah. And when you talk about these stadiums that are filled by Bernie Sanders and AOC acolytes, it is those people that are looking for the answers, and frankly, a lot of sort of people who feel left out, if they're at those stadiums, they are looking to the president to deliver on the promises that he's made.
It's an ambitious agenda. We've said it repeatedly on this programme for the good of the country. We hope he's successful. Eric, it's good to see you. Thanks for dropping by. The former House Majority Leader there, Eric Cantor. Equity futures at the moment just about negative by 0.6%, with an update on stories elsewhere. With your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. The EU Chamber of Commerce is calling on China to make significant changes to its economy in order to avoid further backlash and build economic ties internationally. The chamber said that China's industrial policy framework needs to be changed, urging the country to return to market-oriented reforms to allow Chinese and foreign companies to compete on a level playing field. President Trump has threatened to revoke Harvard University's tax-exempt status after the school refused to change its policies. The university has rejected the administration's calls to make changes to policies, including school leadership, admissions, and diversity. In a post earlier this hour on Truth Social, Trump called Harvard a joke and said the school should no longer receive federal funds. Zoox, the autonomous driving tech company owned by Amazon, is preparing to begin testing its vehicles this summer. Zoox will add Los Angeles to its 6th testing location, laying the groundwork for future commercial services, a company spokesperson said. Zoox was founded in 2014 and acquired by Amazon in 2020. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny in the next hour. Up next on the program, consumer caution.
We were already in an economy that was slowing before all of this tariff uncertainty. You're going to see some movement up in the unemployment rate. Sadly, that's a consequence of a higher inflation, less growth environment, and I think that's going to be the case that leads to even more caution on the part of consumers.
In just a moment, we'll talk about the consumer and housing. We'll catch up with Ratner of Zelman and Associates from New York City. You're watching Bloomberg Surveillance. The consumer in focus this morning, 8:30 Eastern Time, U.S. retail sales. Equity futures going into that negative by 0.6%. On the Nasdaq, we're down by 1.3%. Under surveillance this morning, consumer caution.
We were already in an economy that was slowing before all of this tariff uncertainty and the implementation of massive tariffs across most trading partners. That's very important. The pillars of the U.S. economy were not collapsing, but they were becoming more fragile. You're going to see some movement up in the unemployment rate. Sadly, that's a consequence of a higher inflation, less growth environment, and I think that's going to be the case that leads to even more caution on the part of consumers.
So here's the latest this morning. Concerns about the economy impacting the outlook for housing. The latest Zelman and Associates home builder survey finding increased buyer hesitancy across the board. Alan Ratner of Zelman and Associates joins us now for more. Alan, welcome to the program, sir. Let's pick up on that. If buyers are pulling back, is that because of interest rates or general anxiety about the economy driven by the policy volatility of the last month?
Hey, good morning, John. Thanks for having me. Yeah, I mean, listen, I think this is a culmination of a really stretched and constrained consumer from an affordability perspective. You know, rates have been elevated now for a couple of years, and the housing market has kind of chugged along in spite of that. And home builders in particular have utilized a number of tools to bridge that gap from an affordability perspective. They've bought down mortgage rates, they've adjusted prices where they could. But I think you're just seeing a very tired consumer right now that has really hit the ropes in terms of their ability to afford that home purchase, given where rates are and what home prices have done over the last several years.
Alan, based on some of what we've seen proposed with respect to both tariffs as well as immigration, how much do some of the ongoing restrictions and uncertainty restrain the profitability and the profitability forecast at some of these home builders?
It's really interesting because home builder gross margins have come down quite a bit from their recent highs a couple of years ago. But the biggest culprit has been rising land costs. And the way the home building business works, home builders need to buy land several years in advance before they're actually building a house and selling a house on that land. So what you're seeing in terms of today's gross margin pressure is really a result of what land prices were doing in 2022, 2023. The good news, if there is some, is that we've seen relatively modest inflation in terms of materials and labor over the last couple of years. And we really haven't seen much change to that more recently. Obviously, tariffs do present a risk in the near term. But the good news is, from a per home basis, we estimate the impact is going to be somewhere between $5,000 and $10,000 per home. And we think a lot of that gets absorbed through the supply chain as opposed to getting pushed down to the consumer.
In the meantime, amid all this turmoil, we were expecting slower growth expectations, pushing down rates, which actually would make affordability better on the margins. We're seeing the opposite after the turmoil of the past couple of weeks, given the sell-off in longer term rates. We saw mortgage applications come out this morning. They were down 8.5%, which is actually the biggest decline that we've seen going back to late last year. Alan, at what point do you get concerned that if rates stay at these levels on the long end, that could essentially keep this market kind of in paralysis for a very long time?
Yeah, there's no question. I mean, the byproduct of a slowing economy typically is lower rates. So, at least you could kind of see the silver lining there, that over time that could be a catalyst to bridge that affordability gap and get the consumers back engaged in the market. But if you have high rates and a slowing economy, that's a double-edged sword for the housing market. And I just don't see any potential growth in the near term in that type of backdrop.
Who's best positioned? What companies in this environment?
Well, we've seen relatively stronger trends at the move-up price points, the more discretionary buyers. These are buyers that are not as impacted by mortgage rates and affordability. A lot of these buyers are either paying all cash or putting down a very high down payment. So companies like Toll Brothers, Taylor Morrison, Pulte, these are builders that either focus on the higher end buyer or at least are diversified from a price point perspective. But frankly, the stock market volatility we're seeing here over the last couple of weeks is giving that buyer some pause as well. So there's really no segment that's immune from the volatility. But on a relative basis, we do feel a little bit more positive about that higher end buyer today.
Alan, appreciate the update. Alan Ratner there of Zelman and Associates. Alan, thank you. That last point there on Toll Brothers, even the upper income bracket has pulled back. Now, he's still confident, but even they've been affected by this. And that's something we haven't seen much of in the past 5 years.
Yeah, the wealth effect has really propelled the upper class to really increase spending pretty dramatically and uphold the whole economy, even though the lower end has pulled back. It raises this question about whether this is a forward-leading indicator or whether the housing market has been in a cycle of its own that's kind of over here that we can point to when we're trying to prove a point and basically say it's an anomaly when we don't want to make that point.
I think it's fair to say it's been in a cycle of its own for quite a while.
I think that's fair.
And not just the last 5 years, that's for sure. Equity futures on the S&P negative here by 0.75%. Coming up next, we'll catch up with Rieder of Blackrock, the United Airlines CEO Scott Kirby, Tiffany of Pimco, and Katy Kaminski of Alphasimplex. A big hour coming up. Alicia, we're going to be talking about retail sales at 8:30, and then later on in the afternoon, that address from Fed Chair Jay Powell.
How do you price in the unseen? How do you price in feelings that aren't showing up? That is the ultimate question underpinning all of these interviews and all of the outlooks.
The third hour of Bloomberg Surveillance is up next.
The market is currently making a major potential reassessment of valuations of U.S. assets.
It's not a necessary sell everything type of an environment.
I have a difficult time seeing where the genuine new positive catalysts are going to come from.
A lot is going to change day to day and week to week.
Uncertainty is high, not just for the economy, but for investors.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and this hour focused on the US consumer, whipsawed by tariffs, sentiment already dropping towards a 3-year low, inflation expectations at multi-decade highs. Later this morning, we get a sense of what the US consumer is doing, with retail sales just 30 minutes away. And then this afternoon, Fed Chair Jay Powell addressing the US economy, attempting to offer investors some clarity with very limited visibility.
If you take a page from United Airlines, there are a couple of different scenarios, and you could drive a truck in between how big the gap is between them. There's a real question, not just on what these numbers will reveal when it comes to retail sales, but how the market interprets them, considering that they might not be pricing in the full effects of tariffs and policy uncertainty as they have not trickled out into pricing and other aspects of the economy. On the flip side, from Fed Chair Jay Powell, how much can you really take from his words, given that he doesn't have any more clarity and is trying to message a strong hand to control inflation and look forward into the abyss?
He's pledging to anchor inflation expectations. The decline that we've seen in soft data is notable. The hard data, we're not looking into the abyss right now. He's looking at the hard data and saying unemployment's still around 4%, the economy's okay. And we've heard that on repeat from the FOMC.
You know, Mohamed El-Erian talks a lot about listening to what the companies have to say. And what the companies are saying right now is not dismal. It is not looking into the abyss. It is quite the opposite. It is that other upside surprise type of potential with a consumer that is still spending, concerned, sure, sending in responses to the calls that they get from the University of Michigan saying that we feel terrible. And then they're going out with retail therapy. So at what point can you actually give some credence to the strength that we're seeing coming out of these companies?
We need some therapy from the White House. Will we get it? Negotiations with Japan a little bit later, and just a little ray of light coming out of China. Just a little bit. Based on our reporting that maybe they're willing to come to the table with conditions.
They are responding, according to our report, someone familiar with how the government in China is thinking right now, the CCP. They want respect in terms of stop some disparaging comments coming from cabinet ministries. They want some sort of deal when it comes to sanctions and potentially how the U.S. views Taiwan. I think that's going to be incredibly challenging. And they want something, Jonathan, you said earlier, that Wall Street wants. They want a point person. Now, what else do we see today? Japanese negotiations, and the president himself is going into these negotiations. The prime minister's not there. I think what China needs to start to realize is the point person might be Donald Trump himself.
It is the president. Equity futures right now negative by 0.75% on the S&P 500. Coming up this hour, we'll catch up with Rick Rieder of Blackrock as traders face fresh trade uncertainty. United Airlines CEO Scott Kirby on the carrier's dual forecast, and Katy Kaminski of Alphasimplex reacting to US retail sales. That number 27 minutes away. We begin this hour with trade tensions weighing on the tech sector. Rick Rieder of Blackrock writing, taking opportunistic positions in good quality companies in the equity market has and should continue to pay off for investors with longer time horizons. I'm pleased to say that Rick joins us now for more. Rick Rieder, it's been too long, my friend. Let's get straight to it. I just want to understand what you've been seeing with the team over the last week or so. Have the foreign buyers of treasuries been pulling back?
So, I mean, boy, it's been an incredible period. I mean, so, you know, to start with, I mean, the Treasury market, the move back in the Treasury Friday was extraordinary. This pressure on the Treasury market, concern about international selling, that was pretty amazing. And then we bounced back pretty nicely as some calm has come back in. And then, you know, the volatility in the equity market, the daily volatility, a little bit calmer this week. Does present, you know, similar to what I said there before, it does present some opportunity in these markets. It is, I will tell you, the uncertainty, though, has led to liquidity in these markets that's pretty rough right now. When you go to execute, you got to be very thoughtful and very tactical about how you do it, because markets are very jumpy and very uncertain these days.
And Rick, typically the place you go for liquidity is the Treasury market, deep, predictable. That's why people buy treasuries. Rick, can I get your view on what you think was happening last week? Do you believe that was foreigners pulling back? Is there a question mark over the US safe haven status? Or is that just certain trades unwinding, things blowing up?
It's a great question. I mean, so first of all, you know, when you have this pressure on the currency market, and by the way, it's super acute when you think about equities going down the same time that the currency is going down. Usually the dollar appreciates when you're in this risk-off mode. So you've unquestionably seen the pressure on equities and international disposition of the equity of a number of U.S. equities. In the rates market, it's a bit more blurred, but there's no question about it. There is some concern. We fund so much of our Treasury debt internationally. There is some concern with the currency depreciating. And then, quite frankly, the back end of the curve going through these periods of spasm where inflation is higher. Even if the Fed cuts, what does it do for the back end? There's an argument that when the Fed cuts, the back end becomes less tethered, and in fact, you get a steepening of the curve. So, yes, I think there's some international disposition for sure as the currency weakens, but I think broadly it's this uncertainty, and it's just hard. You watch days like Friday, it's just hard stepping in, particularly in the back end with this uncertainty still out there.
So, Rick, at what point would you step in?
So I like owning the belly of the yield curve, and I like owning, the front end has gotten pretty well priced. I mean, you've got to, and I think the way you all described it, the Fed, you're pricing in an awful lot of cuts for the Fed this year, and you haven't seen that hard data deterioration. I do think you'll see that in labor over the next 2 or 3 months. You'll see some pullback of probably some significance in places like healthcare and education, leisure and hospitality, but we've got to see it. But the belly of the yield curve, there are some opportunities. And quite frankly, Europe is more interesting because you don't have the inflation impact in Europe. The ECB's got to cut more aggressively. So I actually think, where we've seen some real opportunity is actually European rates. Very different. And by the way, you don't have the international disposition there. In fact, that's where you have probably international, I'm sure, you have international buying. So European rates is a place recently we've liked quite a bit.
Can we take this a step further? You talk about how U.S. Treasury markets tend to be the deepest, most liquid, and then you talk about how rocky liquidity has been and how execution risk has become an increasing consideration for you. Have we gotten to the point where on some of these days, the European rates market has actually been more liquid than the U.S. rates market?
Good question. I mean, so more liquid, I don't know if more, certainly the back end of the yield curve, it takes price to get execution. I don't know if it's more liquid. It certainly feels to me like you have this ballast of, you've got an ECB moving, you've got a yield curve that's already pretty steep in Europe. And by the way, if you're a dollar investor, you get a cross-currency swap benefit. And because the curve's so steep, you roll down. So, there are a lot of reasons why I'm sure others, as well as ourselves, have felt like, gosh, it's a safer place to be, even though you're going to get European funding of fiscal initiatives over the next couple of years. That just takes some time. But I don't, I still say the Treasury market generally is much deeper. But Europe, you definitely see more buyers coming in internationally as well as what we see in the States.
Rick, it seems like the picture that you're painting is a regime change. The picture that you're painting is shifting away from the United States and following a real flood of money into some of the overseas markets, and frankly, not betting that the long end of the yield curve will provide the ballast that it has in the past. Can you talk about what else has changed? Does this really undermine or reshape the way you look at 60-40 or the position of gold in your portfolio?
It's a great discussion. That's a long discussion. A ton has changed. Like you say, we've added in the portfolios, not in our fixed income, but other portfolios, we've added gold. We think gold is a good hedge generally. Quite frankly, you have to, during periods like this, you tactically hold more cash in the portfolios. We've done that. Back end of the yield curve and interest rates, and as a hedge when you've got inflation moving potentially significantly higher, not really a big benefit to the portfolio. So, and then the other one, when you get rates backing up, you can get your yield much more attractively using high quality assets. So even though, you're, some pressure on parts of the high yield market, pressures in the lev loan market, you can actually still create, one of our ETF, this BINC ETF, we're able to create over 7% yield and actually improve the quality of portfolio, run more cash. That becomes super attractive. As long as you're not stretching, go down the credit structure into, the triple C rated high yield, you can actually create more yield today. So I like the idea, build some more cash, use some tools that are different than in the past, and then, quite frankly, just get higher quality and more liquidity in the portfolio.
Rick, do you think the rhetoric around the fact that some investors are saying they're dumping dollars, dumping treasuries, that the U.S. is losing safe haven, reserve asset level, do you think that rhetoric is overblown?
I'd say sentiment can change really quickly. We're in this period now where there's clearly a concern about the currency, and there's clearly a concern about how do we bring the debt down, how do we get interest rates down. So I'd say near term, there is a question. Listen, I think reserve currency status is something that is absolutely critical to the United States. We fund a lot of debt globally. The number of, the percentage of trades in the world that happen in dollars, bills as a collateral for for many of the transactions in the world. I think reserve currency status is absolutely critical. Are you denting it? You're definitely denting it. But listen, I think this year is going to change. I think we've got a couple of months here where there's a lot of uncertainty. You got an economy that's probably in recession today in terms of certainly where corporate spend will be. But I think as you get into the back half of the year, things can really evolve. So listen, I think you're chipping away at reserve currency, but I don't think there's a natural alternative. So I think things can change. Hopefully they do.
Rick, hopefully they do. But that last point there I think is important. If we are in recession today, do you think risk assets are appropriately priced for that scenario?
So I would say today, listen, I think the tail has gotten fatter. I think quality assets, they're pretty reasonable. There's a lot of quality assets we've been added to agency mortgages, et cetera. Listen, I think you've got to put a wider range on the equity market today than you've had before. You've got an economy that's pretty uncertain. And you've got to, I think you got to keep your beta a bit more restrained today. Quite frankly, one of the most interesting trades in the last couple of weeks has been to sell puts. Not to necessarily increase, but, the best time to sell insurance is after a hurricane. And there've been some great trades actually sell downside where, gosh, if we go down another 10, 15, 20, depending on single name, go down 10, 15, 20%, you get paid handsomely for taking that. So keep your beta restrained, hunker down a bit in terms of risk, but then find some place like, gosh, I would add if we came down, if markets went down significantly. So anyway, there are a bunch of things to do in this market. But I just think you have to expand your where you think your return objectives are going to be and the probability around it in an environment like this.
Things have changed a lot. Rick, it's good to see you, as always. Rick Rieder of Blackrock there. Rick, thank you, sir. We'll do it again soon. Equity futures on the S&P negative here by 0.8%. Let's get you an update on stories elsewhere with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. China says it's open to trade talks with the U.S., but only after President Trump meets its requirements, like reining in remarks from his cabinet members. Sources tell us that other conditions include a more consistent U.S. position and a willingness to address China's concerns around sanctions and Taiwan. The White House is banning NVIDIA from selling its H20 chips in China, a clear sign that the administration will stay on the course on limiting China's AI ambitions. The restrictions will require a license to export the chips for the indefinite future. NVIDIA warns it will likely report a $5.5 billion write-down tied to inventory and commitments. Elsewhere, the White House is open to probe into the need for tariffs on critical minerals, citing national security and resilience concerns. The order covers a range of minerals, including rare earth elements and uranium, and could lead to tariffs on imports from countries like China, which currently supply 70% of U.S. rare earth imports. And that's your brief. John.
Hey, Danny, thank you. More from Danny later this hour. Later this hour, US retail sales. That drops at 8:30 Eastern Time. Up next, the morning calls, plus the United Airlines CEO, Scott Kirby, on the airline's dual forecast. That's next. This is Bloomberg. This hour is all about the US consumer. Consumer sentiment, according to the University of Michigan survey put out on Friday, close to a 3-year low. Inflation expectations, multi-decade highs, and anxiety about unemployment at levels we haven't seen since 2009. That's how people feel. What are they doing? Retail sales 15 minutes away. Equity futures on the S&P negative by 0.75%. On the Nasdaq, we're down by 1.4%. On the Russell, we're a little bit lighter, only down by about 0.25%. Let's get you some morning calls. First up, Piper Sandler lowering its price target on NVIDIA to 150, citing new export restrictions from the Trump administration. Your second call from Goldman, downgrading target to neutral. The analyst saying tariffs and the inflation outlook are taking a toll on consumer sentiment. And Target right now is down by about 1.2%. And your third and final call from Morgan Stanley, reiterating its overweight on United Airlines, expecting forward guidance to reinforce U.S. airline optimism. The stock is up by 6% in early trading. Let's stick with United. The airline reporting its best first quarter performance in 5 years and offering investors dual forecasts in the face of economic uncertainty, writing in a statement, the company's outlook is dependent on the macro environment, which the company believes is impossible to predict this year with any degree of confidence. Joining us now, the main man, the United Airlines CEO, Scott Kirby. Scott, welcome back to the program, sir. It's good to catch up with you once again. Let me just understand maybe your approach to this earnings report, how you and the team decided, you know what, this time I think we have to do something different and offer a dual forecast. Where did that come from, Scott?
Yeah, we did. We thought it was appropriate to do something different. It starts with, the environment has gotten more difficult. But first, we did have, as you said in the intro, the best margins we've had in 5 years. We grew margins year over year. One of only 2 airlines that are profitable. And as we kind of went through it, we still see a viable path to getting to our, as long as bookings remain stable as they are today, to getting to our original guidance. But we also recognize that there's more macroeconomic uncertainty, that people are fearful of a recession. It hasn't happened yet, but that they're fearful of a recession. And so we wanted to also give investors some outlook on what we think a recession could look like if it happens here at United. So really the goal was to just give investors more information. It's non-traditional. We're the first ones that I ever know of that have done something like this. And so far the feedback has been really positive. And I think investors and others appreciate that we try to give them a more fulsome range as we gave guidance this time.
Scott, can you give us a sense if you were catering more to investor nervousness or whether you were responding to actual weakness that you see in some of the forward bookings by clients?
So I'm guessing you're referring to our capacity changes. And, we're going to pull about 4 points of capacity from the second half of this year. That's really just a pure tactical economic decision. We do see weakness, and because we see weakness, it means we're starting to cancel some of the utilization flying. That red-eye flight that was barely profitable in really peak strong times becomes unprofitable when the demand environment weakens a little bit. Customers have more choice to fly at better times a day, and so they do. And so all we're really doing tactically is pulling some of that marginal flying, marginal in good times, turns negative in bad times. So we're just pulling that out of the system.
How much do you see going forward, though, any kind of retrenchment from consumers whatsoever? A lot of people have been talking about how particularly international travel is going to come down with people from overseas not coming to the U.S. Are you seeing that in forward bookings, or has that kind of been more of a narrative than a reality?
It's been more of a narrative than a reality. We saw weakness starting kind of at the end of January. We saw a step down, but it has stabilized in March, and even the first 2 weeks of April, it has stabilized. And the weakest area we see is actually the low-end domestic consumer here in the United States. International has remained quite strong. International, for what it's worth, is 82% U.S. point of sale. So it's much more dependent on the U.S. economy than foreigners coming to the United States. It's also less corporate than it used to be. And because of that, the leisure traveler is still going. The premium leisure is still there. Typically, even in times of economic weakness, the high-end consumer outperforms. And that's what we thought would happen. That's what we've seen so far. We'll keep watching it, of course, but that's certainly what we've seen so far.
How much does this really put you in a position to consolidate market share? Right now, we keep seeing that among a lot of the leaders in different industries, that this is time for them to compete on price, to compete on some of the offerings, and frankly, squeeze some of the other weaker players in the market so that you emerge on the other side a lot stronger. Do you see that happening with United right now?
Well, United, we've had a 5-year strategy to win brand loyal customers, and we've done that. So really nothing is changing now. We're not doing anything incremental, anything different. We're continuing the path that we have been on because it's worked. It's led to the best margins in good times. I think that lead is going to expand in tough times, not because we're doing anything special, but just because we'll have more seats to sell available to those customers. And when you're the brand loyal airline, when times get tough and you have more seats to sell, more customers migrate to you. And so we'll wind up selling more seats at lower prices because that's the way our yield management system works. But we'll sell just as many seats, but it's going to make it much harder at the bottom of the customer choice pyramid.
Scott, as you know, there's a lot of tension right now between the United States and China. That's been expressed in several rounds of tariffs from either side. We hope they can come to the table and have some talks, but so far, not great. For the maintenance of your plane, sir, and the exposure that you have to China, to Hong Kong, how are you managing that situation at the moment?
At United, we have more of our heavy maintenance work done here in the United States than any airline in the country. We've been growing here in the U.S. In fact, over a 3-year period, we're going to hire about 5,000 maintenance technicians here in the United States, building huge new facilities in Houston and in Orlando, and most of our work is done in the free trade zone outside of Hong Kong, the work that is done in China. So we're monitoring it day by day, but we have a high percentage here in the United States, more than anyone else, and feel good about our setup.
Scott, some CEOs have been quite outspoken about what they'd like to see from the administration on policy. Are you willing to do that? Is there a reason why maybe you'd be a little bit more hesitant to weigh in?
Well, I've spent a lot of time in D.C. This year, as I always do, but I've mostly been focused on listening instead of talking. And so I wanted to understand where the administration was coming from, what their goals were, how they were trying to get there. And I actually by the end of March, felt like I had a pretty good understanding of that. And if you have that kind of understanding and you can put everything that's happening into context, it makes it a lot easier to run, manage the business, to not make panicky decisions. And what I think is happening here is, we're nowhere near the end game yet. These are still the opening moves of the chess game. And I think I and most people that I talk to, or things have slowed down, but we're all in a kind of a take a breath mode. And let's wait till we get to whatever the new normal is going to be before we start making big long-term decisions.
We've all got to take a deep breath. Your stock is up this morning by about 6.5%. I wanted to talk about something with you that we've been talking about for a while on this program. Scott, as you know, one of the most disruptive parts of flying right now is the boarding process. And when you get on, everyone is wrestling to find space to put their bag over their seat. How do we address that situation, Scott? Because I can tell you as a traveller, it is the most annoying experience, and it's not unique to United. It's something we're seeing across the board.
As a father of 7, I understand it, trying to get on with a bunch of kids. And I'd say we're fixing that at United. The biggest thing we can do, we had to put bigger bins on the airplanes. We're over 50% through the fleet at United, but we're putting bins on all the airplanes that are large enough that on a 100% full airplane, every single customer can bring a rollerboard on and put it in the overhead. And I think that, at its core, is how we're going to solve it.
Scott, how much more can you get people to pay for things that they used to know they could get? I know that Frontier used to do that with cans of soda, and then they had to backtrack, or checking bags. Are there other things that you can monetize, or does it really come down to the credit card business, the loyalty program, counting on the front of the cabin?
At United, actually, we're kind of going the opposite direction. We have disaggregated the product. Give customers what they want. If you want the premium product, you can get it. You can go the regular economy product all the way down to basic economy. But, we got Starlink coming next year. We're going to have the fastest Wi-Fi in the sky, and that's going to be free for our customers. So Wi-Fi is going to be free, and it's going to be by far the best experience, the most bandwidth, the fastest speeds for any customers. And, in a lot of ways, increasingly, instead of being an airline that also has a loyalty business, we are becoming a loyalty business that runs an airline. I mean, being able to get customers to Tahiti and Cape Town, that's the cool, sexy reward that you get in the loyalty program. But, the large airlines, particularly like United, we really have the best, the deepest loyalty program. When I talked earlier about brand loyal customers, like customers that want to fly United Airlines. And that is the strength. That's what's given us the resilience to have strong earnings, even in a tough macro environment. It's what's going to let us outperform, even if the economy gets weaker from here. That loyalty of customers, whether you call it the loyalty business or just having brand loyal customers, is the foundation that's letting United outperform.
A masterclass in communications from the firm in the last 24 hours. Scott, I appreciate your time. Thank you. Scott Kirby there, the United Airlines CEO. Up next on the program, US retail sales. We know how the consumer feels. How are they spending? We'll talk about that next on the program. This is Bloomberg. Equity futures on the S&P 500 negative here by 0.75%. Retail sales just seconds away, with the Nasdaq down by 1.4. In the bond market, your 2-year, 10-year and 30-year look like this. Your 10-year yield just about unchanged at 4.32. Your 2-year at 3.80.93. The spread between the soft data and the hard data is incredibly wide. Survey data, consumer confidence, rock bottom. What do retail sales look like? Here's Mike McKee. Good morning, Mike.
Good morning, John. They look pretty good. They look exactly as economists had forecast, coming in up 1.4% for the month of March. We got to check the revisions to February. Ex-autos, though, up a little bit more than thought, 0.5%, but it does show that a lot of the spending was on cars, people getting ahead of the Trump tax increase with that. The control group, the important one that goes into GDP, up 0.4 on the month. That is down from 1 1.3%, revised up for February. So all in all, better news for the retail sales control group than it would appear. And we don't have a revision, it appears, to the advance headline number, 0.2% in February. So 1.4% and 0.4% on a 1.3% revision. So is the control group, and that's the baseline numbers. Shows people were pulling ahead purchases ahead of the Trump tax moves.
So, Mike, you don't think this points to strength as we approach the April data, which is going to become more important to see how this effect from tariffs starts to bite into the economy?
I don't think we can say that at this point. Now, I need to take a look at what the breakdown is, but the expectation was people would act to get ahead of the tariffs. We saw it on the business side with lots of imports of business industrial materials, and now we did see a big change in terms of overall purchases for consumers, and it does look like a lot of that came from cars. Now, the March advance in motor vehicles was 5.3%, so a very strong motor vehicle sales month, it appears. Building materials up 3.3%. Food and beverage stores kind of a light 0.2%, but gasoline stations were down 2.5%. So you can see the impact that the car sales had. They overcame the fall in gasoline prices. General merchandise stores up 0.6%, and of course we always want to know what happens to non-store retailers. They didn't have a great month, up just 0.1%. Food services and drinking places, we all went out and celebrated before the taxes went up on imports, 1.8%. So this doesn't suggest that we've got uniform strength throughout the various categories, but it does suggest people were spending money in March after spending money in February. The question is, do they keep that up now in April?
Or maybe we were just celebrating Liberation Day, Mike. We'll let you go. Mike McKee. Thank you, sir. I'm not sure Mike was. Equity futures on the S&P, negative by 0.8%. On the Nasdaq, we're down by 1.45. In the bond market, 2-year, 10-year, 30-year yields just about lower by a single basis point on a 10-year to 432. Down by 381 on twos. Lisa, we've heard this conversation before. The pull forward in anticipation of tariffs in April. It was always going to shape that March data in a certain way.
It was. It's hard, though, to really reconcile that with the upside revisions that we saw for February. It's not just March data coming in stronger than expected, at least when you look at retail sales, ex-auto and gas. It's also that it was revised up to 0.8% for February from 0.5% initially. You see the same when you look at ex-auto. So there is something else going on in terms of ongoing strength that becomes that much more difficult to know how to read some of the soft data, which, again, is not cohering with what we're seeing in this hard data.
Let's get into this subject with Tiffany Wilding of Pimco. Tiffany joins us now from the West Coast. Tiffany, welcome to the programme, and thanks for waking up so early for us as well over in Newport Beach. Let's talk about this data, retail sales. Tiffany, we know that consumer confidence is rock bottom, and we know it was rock bottom going into that April 2nd tariff announcement. How wide is the gap between what people are saying about how they feel and what you're seeing on the ground happening in the economy?
Yeah, well, I mean, I think the conversation that you were having about pulling forward purchases ahead of tariffs, I definitely think that is boosting demand for goods and retail sales in particular. And I think it was a longer story than just March or February. You know, even though we got many of the we started getting more of the tariff-related announcements in March. Obviously, the big ones were in April. When we look at the data, we see above-trend purchases in goods that really started late last year, in the second half of last year. And so we think actually consumers have been doing this for quite some time. If you look at the sentiment surveys, you also saw inflation expectations that started to rise late last year as a result of tariffs. So we do think that it's going on. Any given month can be noisy, but basically what that suggests is if you're getting a pull forward of purchases here, you know, regardless of what happens in actual tariff policy, you know, if tariffs weren't actually implemented, you know, you should see some softness afterward, just because, you know, consumers had all this pull forward activity.
Tiffany, there's a larger question here about how much we can rely on hard data, given that the soft data, or how much we can rely on soft data, excuse me, when the hard data really isn't confirming the negativity that we're seeing in that soft data. Can you just step back and, as an economist, speak about how much you can rely on the narrowing of the gap between these two metrics, these two inputs?
Well, I mean, I think that, you have to start to see the actual price increases, which we have. There's been many more of these tariff surcharges. Consumers are actually starting to feel the tariff impact now as we're speaking. So I think you could see much more of this, in the data ahead. March was just kind of the precursor to all of the April news. And then I think the other big thing that we all need to watch is just the imports data. The amount and the level of tariffs that we have on China, for example, should over some time, if that is not reduced, basically leave our, reduce our imports from China to basically zero at some point. And so how quickly we see that happen will give us a sense for the disruption in the U.S. economy that's going to happen. Obviously looking at the price data will be very helpful. But I think until consumers start to see that, they won't. They're not exactly changing their behaviors yet. They're trying to pull forward some purchases, but the weakness will come, once we see the other actual effects.
So, Tiffany, is it fair to say that what we're seeing right now in the March retail sales isn't incorporating some of the policy shifts that have really affected sentiment?
Yeah, I mean, we certainly haven't seen. We didn't see any evidence in the, we haven't seen any evidence in the inflation data, that you're getting massive increases in prices. I would say if you squint, maybe in some certain categories like appliances and things like that, you've seen the auto dealers basically say that we're not going to raise prices until we get through the current inventory. So it absolutely makes sense that people are hurrying up to the auto lots to buy the cars at these lower prices right now. So I think you're just not, we are in the early stages of this. I think the April, May, over the summer, once all of this really starts to sink in, you start to have stockouts of certain goods and things like that. That's when you're going to see more of a reaction from consumers, I think.
Tiffany, at the moment, we're seeing good hard data. You have negotiations taking place even today with the White House and trading partners. What does the Fed do with all of this, especially as we have Jay Powell speaking later?
Yeah, I mean, I think this puts the Fed in an incredibly hard position. I think, obviously you have this outlook for inflation to accelerate, and that's shown up in inflation expectations. I know the Fed has dismissed the increase across, most major surveys in inflation expectations, including the U of Michigan report, which has a longer-term measure. They've sort of downplayed that or dismissed it. The survey of professional forecasters from the Philly Fed is a key measure that they will be looking at. We will get that in May ahead of that FOMC meeting. And I think if you start to see that longer-term inflation expectation measure accelerate, then that can be a bigger problem for the Fed. And we've said we think it constrains them. And when we say constrains them, what we mean is that we think they really need to see the labor market, really cracking here. Unemployment, accelerating job growth that's turning negative for them to respond. That 2018, 2019 type of response that was more preemptive, they expected weakness, so they cut ahead of that. You're not going to be able to see that from them this time. So it's going to be more delayed, but that means once they do start cutting, they do start to see that weakness, you could see, a much more swift response, although more delayed.
Tiffany, is there a metric you have in mind? Unemployment at the moment at 4.2. Is there a number that you think would trigger that moment for them?
Yeah, I mean, I think, and I think the speed here is key. If you're seeing unemployment that's accelerating up to 4.5 or above pretty quickly, within the context of a few months, at the same time, you're seeing, retail sales and consumer spending collapse. You're seeing imports collapse. All of those things, I think, would contribute to them cutting rates. I think in terms of the data flow and when their meetings are, I think May is probably too soon. Like we've been talking about, the actual brunt of all of this, is likely going to be seen in the data. In the early summer to even midsummer. So I think June and maybe even the May and maybe even the June meeting is too early to really start to see the labor market effects. We think it might be September before they could really get a good read on all of this.
Interesting. Tiffany, appreciate the input. Thank you. Tiffany Wilding there of Pimco. Tiffany going through it there for the Federal Reserve that unlike last year where they could act preemptively, The first time of any kind of crack, the first sign of any cracks whatsoever in the labour market, they moved aggressively 100 basis points. So this time around, it's basically a commitment to being late. If you're waiting until September, you're waiting for unemployment to go north of 4.5%. A lot of people would say you're already late.
Right, which again goes to this question of how much can they signal, considering that the market will get out in front of them. They want rates to give some sort of downward pressure to inflation when it is coming up and inflation expectations over the long term. As I was listening to Tiffany there, I was thinking, okay, so they're going to cut a full percentage point in September? Seriously? I mean, if it really does weaken, at what point are they ready to step in with some really serious
The good news for Chairman Powell later on this afternoon is that we don't see that weakness yet. See it in the survey data, sure. We've seen it in the markets and they've taken note of that, but we don't see it in the retail sales number we just got 10 minutes ago.
The good news for him is that expectations are very low and that really people are not looking for any signal from him, and they understand that it is a black box that he is in with a blindfold, and that his job is to be a politician and to be something of a messenger of calm, steady, and not overreacting in any which way.
You'll get some version of that at 1:30 this afternoon, so look out for that. Katy Kaminski of Alphasimplex joins us now for more. Katy, welcome to the programme. We caught up with Rieder of Blackrock earlier on this hour. I wouldn't call him a bear. He was more constructive in the long term, but short term he was cautious. He was talking about a gold position, building up cash. He was talking about being in a recession as we speak. Katy, what's your approach to this moment?
So this is a good question, because right now what we're seeing is that technical signals have really sort of stepped away. There's very little direction in the market at this point in terms of what we're seeing in our signals for both bonds and stocks. This concerns me because it really doesn't seem like there's any sort of catalyst that is going to change that narrative very easily soon, just given the complexities of negotiations in this particular trade war. I'll say there's a few exceptions, and that's why this is an interesting point. With retail sales today, commodities have been interesting, especially energies, and you've seen some other exceptions there, like soybeans, that have really rallied as a function of the trade war impact. So gold, metals, energies, agriculturals are places to kind of look around right now that things are moving.
Before we dig into commodities, Katy, I am curious your view on trend-following strategies at a time like this of incredible policy uncertainty. Do they kind of lose their relevance, at least in the short term, because there really isn't a trend to follow other than maybe a truth post?
This is a very good question, and we actually wrote an article this week about it, about crisis or correction. And the reason that we examined how trend following does during different drawdown periods for equities is that those initial drawdowns, when there's a shock, often do create a dispergence of trends that are actually quite hard to follow. And it's usually the aftermath of changes in macro policy that provide more opportunities. So I think the way that we're thinking about it is, what are the long-term trends that will occur as a function of us realizing the impact of this policy? But yes, you're correct. Any sort of short-term shock is very difficult for a lot of systematic strategies and other strategies that are following sort of prevailing themes going into a massive shift.
I don't mean to put you on the spot, Katy, but there is some speculation out there that some of these trend following and systematic type strategies are behind some of the volatility, or have actually exacerbated it with leverage unwinding and positions that get stopped out, and a lot of trends that completely got reversed in just a matter of hours or minutes. Do you believe that? Do you think that that actually has been a contributor to the incredible volatility that we've seen?
Well, I'd say, I think it's hard to say that just one particular strategy is driving all the volatility. What we have seen is that across the board, de-risking occurred. And that occurred not just in systematic strategies, but in long-only investors and retail investors. So I do think that, the de-risking that does occur when there's a shock is something that people have to think about. And it's something that, when we look at trend, for example, it's actually something that is measured and controlled, whereas in certain strategies, it could be much more aggressive.
Katy, Rick Rieder said what we could see maybe is a dent with the U.S. dollar in terms of a global reserve currency. Do you buy that?
We're actually seeing a little bit of that right now, and I think that's something that's interesting. Let's just take a little step back at what we've just seen. First of all, we had equities take massive losses, but at the same time, the dollar has not been stronger. So if you're actually trying to improve your trade balance, it should be pro-dollar. It means that you're actually seeing potential weakness of U.S. assets. And you've seen that in the Treasury market as well. Look at both Treasuries and the dollar. They both got hit by sort of this risk-off move related to post-Liberation Day. And that to me is a suggestion that the appetite for U.S. assets could be something that is a question, making both the dollar and U.S. Treasuries more vulnerable going forward as we try to navigate this new policy.
More than 2/3 of transactions, though, in the world come and stem from, or at least on the margins, hit the dollar. Who fills that void?
That's a good question. I mean, I think as that starts to shift, we have seen things like the yen, the euro, other sort of currencies rally in response to this type of move. It may just be sort of a preliminary thought question about sort of what happens if the dollar loses some of its strength. Where do we go? But right now, the data is showing that, the yen was the beneficiary of this, and so the euro. And I think that narrative will change as we learn more about how much of an impact this policy has.
Things can change quickly, that's for sure. Katy, appreciate the update from you. Katy Kaminski there of Alphasimplex. You can get wrapped up in the emotion and the drama down in Washington, D.C., or just attempt to call balls and strikes. Just now, looking at where things are, corporate America's doing OK. If you look at the earnings we've had from Wall Street, from United Airlines, things are better than we anticipated only a number of weeks ago. And I would say the same applies to trade too. April 2nd, they were talking about going big, large, aggressive, a huge global realignment. In the last week alone, I'm hearing more about negotiations and exemptions. That is a very different position compared to where we were only a few weeks ago.
And there's actually a connection between these two. If you take a look at some of the polls coming out of CBS and YouGov, as well as a whole host of others, what you see is, yes, a majority of Americans are concerned about the potential of increase in tariffs and inflation, but they do think it's a negotiation. And they do think that there does need to be change. I mean, there is a difference between some of the taking things to the worst case scenario versus what people are actually doing and how they're taking it in terms of the messaging at home.
This is an ongoing process. We'll continue to follow all the news as it comes in. On the S&P 500, we're down by about 0.9%. The earnings report of the season, though, I have to say, I think is going to be Apple. 1st of May. That's got to be the big one, right?
What kind of range are they going to give? Potentially zero or potentially,
A bull case,
yeah.
A bear case, a base case?
Yeah, I mean, they're going to be in a particular tricky situation because they're going to have to also be messaging their earnings to a specific person. So a lot of what we're hearing right now is also messaging. As people say, look, we're with you, we got you, we're going to give you what you want, please give us what we want.
You're not talking about investor relations, are you?
Well,
You're talking about White House relations.
100%, and when you hear it across the board, people are speaking directly to one person again and again.
Tech earnings a few weeks away. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just to recap the most recent data, March U.S. retail sales came in line with estimates with a headline number of 1.4%. It's the biggest increase in more than 2 years, driven by a jump in car purchases, suggesting that consumers are scrambling to get ahead of auto tariffs. Elsewhere, President Trump said that he will attend a meeting with Japan to discuss tariffs, military support, and trade fairness today. In a post on Truth Social, Trump said U.S. Treasury and Commerce secretaries will also be in attendance. Japan is one of the first countries to negotiate the levies. Lyft is expanding into Europe. The company has announced it's buying Free now for about $197 million from BMW and Mercedes-Benz. The taxi-focused mobility platform operates in over 150 cities in 9 countries across Europe. The transaction is expected to close in the second half of this year. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. One big event still to come. Chairman Powell later on this afternoon. We'll get you a preview with Mike McKee in just a moment. From New York, this is Bloomberg. Can you believe it's 2 weeks since Liberation Day, April 2nd? 2 weeks. Total blur. Equity futures right now in the S&P, negative by 0.9%, and it feels like nothing. Why? Because a week ago, last Wednesday, this market was down 3%, then rallied 10. A 13 percentage point intraday swing on equity futures. This is calm relative to the previous week. Coming up this week, Here's your trading diary. President Trump saying he'll meet with Japanese trade representatives today, so look out for that. 1:30 Eastern Time. Remarks from Fed Chair Jay Powell tomorrow. An ECB rate decision plus another round of jobless claims, and we'll get Netflix earnings. Friday, of course, remember, markets closed for the Good Friday holiday. Joining us now, Mike McKee with a preview of what to expect at 1:30 Eastern Time. Mike, what are you and the team looking for?
Well, we're looking to see if there's any way Jay Powell can reframe the argument that the Fed has made so far, and that is that they don't know what's going on, so they're going to have to be flexible on both ends. For the past week, the chair and all of the other Fed members who've spoken have said the same thing, that if unemployment goes up, the economy weakens, they can cut rates. If inflation goes up, they can raise rates. But since they don't know what's going on, they're in a good position to just kind of sit where they are. That's what we're hearing from CEOs as well, including Scott Kirby, who was on with you from United Airlines this morning. They've put out a forecast. If the economy weakens and people stop flying, that will be bad for our business. But if the import tariff taxes aren't so bad, then maybe people continue to fly and we can get through it. Nobody really knows at this point. I think Tiffany Wilding had a good point. The Fed's not going to know for a while, and you were making the point too, John. They're going to be late to this, and they know that, but there isn't a whole lot they can do about it. So how does Jay Powell say that differently or reassure Wall Street? That'll be the question of the day.
We're going to find out in a few hours' time. Looking forward to your coverage, Mike, as always. Mike McKee there over in Chicago. Chairman Powell addressing the Economic Club of Chicago at 1:30 Eastern Time.
Yeah, honestly, to me, it's going to be very unclear why he has any incentive whatsoever to come out with some sort of bold statement. Why not just say as little as he possibly can and say that we're watching everything closely and we can respond if we see something that warrants it. But otherwise, we're in a great place. So thank you for coming.
You're making me think I don't need to tune in for that, which makes me think I can tune in for something more important, something Jay Powell's looking probably to try to get data from to understand where the economy is going. And that is the fact that the President of the United States is joining these negotiations. I can't really explain how unusual this is, that the president goes in with the negotiating teams. He's supposed to be the last person to see a deal before it's signed off on, not to be there in the middle negotiating. But wants to take a front row seat and a real hands-on approach.
I think it's fair to say they are, for communication purposes maybe, a little bit later on this afternoon.
Roll out the red carpet. Look what happens when you come.
First come, first served.
You know, guess what? We're going to give you tea. We're going to get you really nice cookies. And you know what? The president's going to be there too.
And you get Secretary Besson as well.
Yeah.
And if you come late, who do you get instead?
Just straight Navarro.
Exactly. This is how it works. Good cop, bad cop. Futures right now down by 0.9%. Coming up tomorrow, Jean Barvan of Blackrock, former senior Trump trade advisor Kellyanne Shaw, Vishal Khanduja of Morgan Stanley, and Mohammed Al-Erin of Queen's College, Cambridge, joining us on set tomorrow in the studio. Look out for that. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.